Hello traders and price action enthusiasts. Welcome back to the continuation of Trading Price Action Trends by Dr. Al Brooks, one of the most detailed and practical guides to mastering price movement in trending markets. In this segment, we'll dive into Part 2 and Part 3, covering chapters 13 through 20. In these chapters, Brooks deepens our understanding of trend mechanics, structure, and how to read market context like a seasoned professional. Here's a quick preview of what's ahead. Chapter 13. We begin with the foundation, trend lines, the building blocks of price structure. Chapter 14. Then we draw broader boundaries with trend channel lines, helping you spot key entries and exits. Chapter 15. Explore how channels reflect balance and imbalance in the market. Chapter 16. Learn to identify microchannels, subtle patterns that often signal continuation or change. Chapter 17, we pause to examine horizontal lines, swing points, and key price levels that markets naturally respect. Chapter 18, a full walkthrough, how to trade a trend with real chart examples and logic behind each move. Chapter 19, recognize signs of strength that confirm the health of a trend or warn of potential reversals. Chapter 20, finally, uncover the powerful and recurring concept of two legs, a core idea in Brooks's price action framework. This section is rich in actionable insight and practical chart reading, ideal for both intraday and swing traders. So grab your notepad, tune in, and let's sharpen your price action skills together, one chapter at a time. And if you're finding value in this audiobook series, don't forget to like, comment, and subscribe for more. Let's get started.
Part 2. Trend Lines and Channels. Although many traders refer to all lines as trend lines, it is helpful to traders to distinguish a few subtypes. Both trend lines and trend channel lines are straight, diagonal lines that contain the market's price action, but on opposite sides, forming a channel. In a bull trend, the trend line is below the lows and the trend channel line is above the highs, and in a bear trend, the trend line is above the highs and the trend channel line is below the lows. The lines defining the channel most often are parallel or roughly parallel, but are convergent in wedges and most other triangles, and divergent in expanding triangles. Trend lines most often set up with trend trades, and trend channel lines are most helpful finding tradable countertrend trades. Curved lines and bands are too subjective, and therefore require too much thought when you are trying to place trades quickly. A channel can be up, down, or sideways, as is the case in a trading range. When the channel is sideways, the lines are horizontal, and the line above is the resistance line, and the line below is the support line. Some stock traders think of a resistance line as an area of distribution, where traders are exiting their longs, and support lines as an area of accumulation, where traders are adding to their longs. However, with so many institutions now shorting as much as they are buying, a resistance line is just as likely to be where they are initiating a new short as it is that they are exiting or distributing their longs. Also, a support line is just as likely to be an area where they are exiting or distributing their shorts, as it is a place where they are initiating longs. Lines can be drawn to highlight the price action, making it easier to initiate and manage trades. See figure PII.1. Line 1 is a trend channel line above an expanding triangle, and line 2 is a trend channel line below an expanding triangle. Because the channel was expanding, there was no trend and therefore no trend line. Line 3 is a trend line below the bars in a bull trend and is a support line, but line 10 is a trend line above the highs in a bear trend and is a resistance line. Line 4 is a trend channel line in a bull trend and is above the highs, and line 9 is a trend channel line in a bear trend and is below the lows. Lines 5 and 6 are horizontal lines in a trading range, which is just a horizontal channel. Line 5 is above the highs and is a resistance line, and line 6 is below the lows and is a support line. The channel formed by lines 3 and 4 is convergent and rising and therefore a wedge. Lines 7 and 8 are trend lines in a small symmetrical triangle, which is a convergent channel. Since there is both a small bear trend and a small bull trend within a symmetrical triangle, the channel is made of two trend lines, and there is no trend channel line. A convergent triangle can be subdivided into symmetrical, ascending, and descending types, but since they all trade the same way, these terms are not necessary. Deeper discussion of this chart. The first bar of the day broke above yesterday's high in figure PII.1, but the breakout failed. Since the final 6 bars of yesterday were bull trend bars, only a second entry short could be considered. but there was no reasonable signal. The market entered a small trading range for the first 7 bars, and therefore the market was in breakout mode. Traders would buy on a stop at 1 tick above the high and go short at 1 tick below the low of the opening range. The market broke to the upside, and a minimal target was a measured move up equal to the height of the expanding triangle. Chapter 13. Trend Lines. A bull trend line is a line drawn across the lows of a bull trend, and a bear trend line is drawn across the highs of a bear trend. A trend line is most helpful when looking for entries in the direction of the trend on pullbacks, and in the opposite direction after the trend line is broken. Trend lines can be drawn using swing points or best fit techniques, such as linear regression calculations, or simply quickly drawing a best approximation. They also can be created as a parallel of a trend channel line, and then dragged to the trend line side of the bars. But this approach is rarely needed, since there is usually an acceptable trend line that can be drawn using the swing points. Sometimes the best fit trend line is drawn just using the candle bodies and ignoring the tails. This is common in wedge patterns, which often do not have a wedge shape. It is not necessary to actually draw the line when it is obvious. If you do draw a line, you usually can erase it moments after you verify that the market has tested it, because too many lines on the chart can be a distraction. Once a trend has been established by a series of trending highs and lows, the most profitable trades are in the direction of the trend line until the trend line is broken. Every time the market pulls back to the area around the trend line, even if it undershoots or overshoots the trend line, look for a reversal off of the trend line and then enter in the direction of the trend. Even after a trend line breaks, if it has been in effect for dozens of bars, the chances are high that the trend extreme will get tested after a pullback. The test can be followed by the trend continuing, the trend reversing, or the market entering a trading range. The single most important point about a trend line break is that it is the first sign that the market is no longer being controlled by just one-side buyers or sellers, and the chances of further two-sided trading are now much greater. After every trend line break, there will be a new swing point on which to base a new line. Typically, each successive line has a flatter slope, indicating that the trend is losing momentum. At some point, trend lines in the opposite direction will become more important as control of the market switches from the bears to the bulls or vice versa. If the market repeatedly tests a trend line many times in a relatively small number of bars, and the market cannot drift far from that trend line, then either of two things will likely happen. Most of the time, the market will break through the trend line and attempt to reverse the trend. However, sometimes the market does the opposite and moves quickly away from the trend line as traders give up trying to break through it. The trend then accelerates rather than reverses. The strength of the trend line break provides an indication of the strength of the countertrend traders. The bigger and faster the countertrend move, the more likely that a reversal will occur, but there will usually first be a test the trend's extreme, for example, in the form of a lower high or a higher high in the test of the high of the bull trend. It is helpful to consider a gap opening, and any large trend bar to be effectively breakouts, and each should be treated as if it is a one-bar trend, since breakouts commonly fail, and you need to be prepared to fade them if there is a setup. Any sideways movement over the next few bars will break the trend. Usually, those bars will be setting up a flag and then be followed by a with trend move out of the flag, but sometimes the breakout will fail, and the market will reverse. Since the sideways bars broke the steep trend line, you can look to fade the trend if there is a good signal bar for the reversal. Which trend lines were valid? Every one of them that you can see has the potential to generate a trade. Look for every swing point that you can find and see if there is an earlier one that can be connected with a trend line, and then extend the line to the right and see how price responds when it penetrates or touches the line. Notice how each successive trend line tends to become flatter until some point when trend lines in the opposite direction become more important. In actual practice, when you see a possible trend line and you are not certain how far it is from the current bar, draw it to see if the market has hit it, and then quickly erase the line. You don't want lines on your chart for more than a few seconds when trading, because you don't want distractions. You need to focus on the bars and see how they behave once near the line, and not focus on the line. As a trend progresses, countertrend moves break the trend lines and usually the breakouts fail, setting up with trend entries. Each breakout failure becomes the second point for the creation of a new, longer trend line with a shallower slope. Eventually, a failed breakout fails to reach a new trend extreme. This creates a pullback in what may become a new trend in the opposite direction, and this allows for the drawing of a trend line in the opposite direction. After the major trend line is broken, the trend lines in the opposite direction become more important, and at that point, the trend has likely reversed. Figure 13.1 illustrates one of the most important points that everyone needs to accept as reality if they are to become successful traders. Most breakouts fail. The market repeatedly races toward a trend line with very strong momentum, and it is easy to get caught up in the strength of the bar and overlook what just took place over the past 20 bars. For example, when the market is trending up, it has many very strong sell-offs that quickly drop to the bull trend line. This makes beginners assume that the market has reversed, and they sell just above, at or below the trend line, believing that with so much downward momentum, they will ride that wave to a big profit and be entering the new bear trend near the very beginning. At the very worst, the market might bounce a little before having at least a second leg down that would allow them to get out at break-even. When they are making their decision to trade against the trend with the hope that a new trend is starting, all they are considering is the reward that they stand to gain. However, they are ignoring two other essential considerations for every trade: the risk and the probability of success. All three must be evaluated before placing a trade. While beginners are shorting on those strong sell-offs near the bull trend line, experienced traders are doing the opposite. They have limit orders to buy at and just below the trend line, or they will buy there with market orders. The market usually has to go at least a little below the trend line during a sharp sell-off to find information. It needs to know if there will be more sellers or more buyers. Most of the time, there will be more buyers and the bull trend will resume, but only after there has been a big break below the trend line and then another rally that tests the old bull high by forming either a higher high as it did here or a lower high. Trend lines are important on all time frames, including the monthly chart of the Dow Jones Industrial Average, INDU. Note in Figure 13.2 how the 1987 crash at bar 3 ended on a test of trend line B drawn from bars 1 and 2. The 2009 bear market reversed up from trend line A, drawn from the 1987 crash and the 1990 low. But since the 2009 bear trend was so strong, there is a reasonable chance that the market will again test line B. It is unlikely that the market will come all the way back to the line C breakout, which coincided with the Republican takeover of the House and Senate in 1994. Normally, when a breakout is followed by a protracted trend, it is unlikely to be touched again, but it usually gets tested. Since we never adequately tested it, it may remain as somewhat of a magnet, drawing the market down. However, it was many bars earlier and likely has lost some or all of its magnetic pull. Incidentally, the market's direction is usually only about 50% certain because the bulls and bears are in balance most of the time. However, when there is a strong trend, traders can often be 60% or more certain of the direction. Since the 2009 crash was so strong, it is probably 60% certain that its low will be tested before the all-time high is exceeded. Bears will probably start looking at the current bear rally as a potential right shoulder of a head and shoulders top, a double top with the 2007 high, or an expanding triangle top if the market reaches a new all-time high. Price action traders see each of these as simply a test of the top of the 12-year long trading range. A trend line can be drawn using a parallel of a trend channel line, but this rarely provides trades that are not already apparent using other more common price action analysis. In Figure 13.3, a bear trend channel line from bars 1 to 4 was used to create a parallel, and the parallel was dragged to the opposite side of the price and anchored at the bar 2 high. Because this then contained all of the prices between the bars 1 and 4 beginning and end of the trend channel line. Bar 6 was a second attempt to reverse the break above that line, and therefore a good short setup. The trend line created as a parallel to the bar 1 to bar 4 trend channel line was almost indistinguishable from the trend line created from the highs of bar 2 and bar 5, not shown, and so added nothing to a trader looking for a short. It is shown only for completeness. Deeper discussion of this chart. Bar 6 in figure 13.3 was also a failed overshoot of the bars 3 and 5 trend channel line, making the bar 6 short an example of a dueling lines trade. This is where a trend channel line in a pullback, or a leg of a channel, intersects the channel's trend line. Here, the pullback to the trend line was in the form of a wedge bear flag created by bars 3, 5, and 6. After the first couple of pushes, sometimes the trend channel line that they generate can be used to create a channel. Figure 13.4 is the daily chart of the Russian communications company Mobile Telesystems, MBT. The push up to bar 6 was strong, and there was a second strong move up to bar 8. After the wedge bottom at bar 4, the market might have been developing a trend reversal and a bull channel. Traders could have used the trend channel line from bar 6 to bar 8 to create a parallel, and then they could have dragged it to the bar 7 swing low in between them to create a channel. Traders then watched the sell-off from bar 8 to see if it was followed by a reversal up at the bottom of the channel. The bar 9 bull reversal bar was the buy setup. Similarly, bar 10 was in the area of the bar 1 high, so traders were aware of a possible double top. The market gapped down on bar 11 and had a second leg down to the bar 12 low. Traders could have drawn a trend channel line across their lows, and then they could have dragged it to the high in between them, which happened to be the top of bar 11. They would then wait for a rally off the bar 12 low to see if it found resistance at the top of this potential new bear channel. When they saw the strong bear reversal bar at bar 13, they could have shorted, expecting that the market might have been in the process of channeling down. As shown in figure 13.5, when a possible head and shoulders pattern is setting up, the area around bar 4 is the head. A trend channel line drawn across the neckline bars 3 and 5, and dragged to the left shoulder, bar 2, sometimes gives an approximation of where the right shoulder might form, bar 6. When the market falls to that level, traders will begin to look for buy setups, like the strong bull inside bar that followed the bar 6 sell climax. This is of minor importance since the most recent bars are always much more important in deciding where to enter. This is the 60-minute chart of Infosys Technologies, Infi, one of the leading software companies in India. In figure 13.6, the dotted trend channel line that runs from the bar 3 low to just below the bar 5 low was created as a parallel of the dotted bear trend line drawn across the highs of bars 1 and 4. Although neither bar 5 nor bar 6 touched it, they were close enough, and many bulls would have been satisfied that the bottom of the channel was adequately tested, and therefore the market could be bought. However, many traders prefer to see a penetration of the channel before looking for a reversal up that should penetrate the top of the channel as a minimum target. When a trend channel line is so steep that it is tested but not broken, it is wise to look for other possible ways to draw the line. Maybe the market is seeing something that you have not yet seen. Since the bear trend began in earnest with the bar 2 large bear trend bar, it is reasonable to consider that as a starting point for a trend line. If you draw a trend line from bars 1 to 4 and then create a parallel and drag it to the bar 3 low, you would discover that bar 6 was the second reversal up from an overshoot of the bottom of that channel. Bar 5 was the first. The market, as expected, rallied and broke above the top of the channel. It then pulled back and ran even further up. Deeper discussion of this chart. Today broke above yesterday's high with a gap up in figure 13.6, and the breakout failed. The market trended down for 4 bars, creating a trend from the open bear trend. Bar 2 was the first pullback, and that is usually a reliable entry into the bear trend. It was a breakout to the downside, and therefore a spike down, and was followed by a bear channel that ended with 3 pushes down to bar 3. Since a spike and channel pattern is a type of climax, the reversal usually has 2 legs up, and the rally usually tests the top of the channel where it often sets up a double top bear flag short, as it did here. Bar 4 was another spike down, and there was an even larger bear spike 8 bars later. It was followed by a bear channel, and the top of that channel was tested by a bull spike and channel that ended just after 1200 p.m. PST. There was then a 4-bar sell-off that tested near the bottom of that bull channel, setting up a double bottom bull flag, and it was followed by a strong rally that tested the bar 4 high. This was a potential double top bear flag setup going into the next day. The average daily range was about 20 points, so once the market got down to about 20 points below the open, This gave traders another reason to look for a bounce. As shown in figure 13.7, the dotted bear trend line was repeatedly tested about 15 times, and eventually the bulls gave up. The trend line was a best fit line across the highs to illustrate all the tests of the resistance line. The bulls finally stopped trying. They sold out of their longs, adding to the selling pressure, and stopped looking to buy again until the market fell for many more bars. The market was therefore very one-sided, and the bears were able to accelerate the trend downward. Usually when the market repeatedly tests a trend line and is unable to fall from it, it breaks above it. Other times, like here, it accelerates downward and ends in a climax around the bottom of a channel. The trend line drawn across the highs of bars 3 and 15 contained all of the highs and therefore was a reasonable choice for the top of the channel. A parallel was anchored to the bar a low, and both bars B and C broke through the bottom of the channel and reversed up. Once the reversal was confirmed by the 2-bar reversal at bar C and the bar after, the first objective of the rally was a test above the top of the channel. There was a breakout on bar D, then a 1-bar pause, which is a type of pullback. Instead of finding resistance and sellers at the bear trend line, the market found strong buying and had a strong bull breakout above the bear channel. Deeper discussion of this chart. Today tested the moving average in figure 13.7 and then broke out below yesterday's swing low. Traders could short below the first bar since it was a low too short. It was a small 2-legged pullback to the EMA or below the 4th bar of the day. However, the 2nd, 3rd, and 4th bars were large and almost entirely overlapping, and this is a sign of uncertainty, one of the hallmarks of a trading range. This makes shorting below that 4th bar more likely to be followed by a breakout that would not go far before getting pulled back by the magnetic force of that tight trading range. The market remained in a trading range for several hours and then broke down to a new low of the day. The two-sided forces continued to control the market, and the market reversed up into the close, ending the day about where it began. Chapter 14. Trend Channel Lines. In a bull or bear channel, the trend channel line is on the opposite side of the price action from the trend line and has the same general slope. In a bull trend, a trend line is below the lows and a trend channel line is above the highs, and both are rising up and to the right. A trend channel line is a useful tool for fading a trend that has gone too far, too fast. Look for an overshoot that reverses, especially if it is the second penetration that is reversing. A trend channel can have roughly parallel lines, or the lines can be convergent or divergent. When they converge and the channel is rising or falling, the channel is a wedge, and this often sets up a reversal trade. In general, any channel that is sloping up to the right can be thought of as a bear flag, and it is likely that there will be a breakout through the bottom of the channel. The breakout can lead to a trend reversal or to a trading range that can break out to the upside or the downside. Sometimes the market will accelerate to the upside and break out of the top of the channel. When this happens, it is usually a climactic rally that leads to a reversal back into and often through the bottom of the channel, but sometimes it can be the start of another leg up in an even stronger bull trend. Similarly, a channel that slopes down to the right can be thought of as a bull flag, and the market will likely break out of the channel to the upside. This can be the start of a trend reversal or a trading range. If the market falls through the bottom of a falling channel, the breakout will usually fail within about 5 bars and lead to a reversal, but it can also be the start of a new, stronger bear leg. A trend channel line can be created as a parallel of a trend line that is then dragged to the opposite side of the price action. It can also be drawn across spikes on the opposite side of the channel, or it can be drawn as a best fit line, like a linear regression line, or by simply visually drawing a best fit line. In a bull trend, a trend line is drawn across 2 lows. If that trend line is used to create a parallel that will be used for a trend channel line, drag the parallel line to the opposite side of the trend. You want it to be above the highs of all of the bars located in between the 2 bars used to create the trend line, so drag it to the high of whatever bar will leave it touching that bar alone. Occasionally, you will get a better sense of the trend if you anchor the line to a bar that is outside of the 2 bars. Always do whatever best highlights the trend. Sometimes there will be a single spike up within an otherwise fairly tight channel, and when that is the case, it is usually best to ignore it and use the other bars for the location of the trend channel line. However, be aware of the possibility that the market might ultimately decide that the channel line should instead be across that spike up. If the market begins to have wider swings, and they all are stopping at the top of the channel that uses that one spike as the anchor for the trend channel line, then you should use that wider channel. A trend channel line can also be created on its own, rather than as a parallel of the trend line. In a bear swing, a trend line will be downward sloping and above the highs. The trend channel line will have a similar slope, but draw it between any two swing lows in the bear swing. It is most useful if it is below all of the other bars in the swing, so choose the bars that will give that result. Trend channel line overshoots are closely related to wedges and should be viewed and traded as if they are one and the same. Most wedges have failed trend channel line breakouts as the trigger for a reversal trade, and most trend channel line overshoots and reversals are also wedge reversals, although the wedge may not be obvious or have a perfect wedge shape. The wedges are less obvious and less likely to be present when the trend channel line is constructed as a parallel of a trend line, but wedges are still often present. When a channel has a wedge shape, it is due to urgency. For example, in a wedge top, the slope of the trend line is greater than the slope of the trend channel line. The trend line is where the with trend traders enter and the counter-trend traders exit, and the opposite happens at the trend channel line. So if the slope of the trend line is greater, that means that the bulls are buying on smaller pullbacks and the bears are exiting on smaller sell-offs. What first distinguishes a wedge from a channel where the lines are parallel is the second pullback. Once the second push-up has begun to reverse down, traders can draw a trend channel line and then use it to create a parallel line. When they drag that parallel line to the bottom of the first pullback, they have created a trend line and a trend channel. That tells bulls and bears where support is, and bulls will look to buy there and bears will look to take profits there. However, if the bulls begin to buy above that level and the bears exit their shorts early, the market will turn back up before it reaches the trend line. Both are doing so because they feel a sense of urgency and are afraid that the market will not drop down to that support level. This means that both feel that the trend line needs to be steeper and that the trend up is stronger. Once the market turns up, traders can redraw the trend line. Instead of using the parallel of the trend channel line, they now can draw a trend line using the bottoms of the first two pullbacks. They now see that it is steeper than the trend channel line above, and they begin to believe that the market is forming a wedge, which they know is often a reversal pattern. Traders will draw a parallel of that new steeper trend line and drag it to the top of the second push-up, in case the market is forming a steeper parallel channel instead of a wedge. Both the bulls and the bears will watch to see whether the original trend channel line will contain the rally or the new, steeper one will be reached. If the original one contains the rally and the market turns down, traders will think that although there was more urgency in the buying on the second pullback, that urgency did not continue on the third push-up. The bulls took profits at the original, shallower trend channel line, which means that they exited earlier than they could have. The bulls were hoping that the market would rally to the steeper trend channel line, but now are disappointed. The bears were so eager to short that they were afraid that the market would not reach the steeper, higher trend channel line, so they began to short at the original line. Now, it is the bears who have a sense of urgency and the bulls who are afraid. Traders will see the turn down from the wedge top, and most will wait for at least 2 legs down before they look for the next major pattern to buy or sell. Once the market makes its first leg down, it will break below the wedge. At some point, the bears will take profits and the bulls will buy again. The bulls want to cause the wedge top to fail. When the market rallies to test the wedge top, the bears will begin to sell again. If the bulls begin to take profits, they believe that they will be unable to push the market above the old high. Once their profit-taking, combined with the new selling by the bears, reaches a critical mass, it will overwhelm the remaining buyers and the market will turn down for that second leg. At some point, the bulls will return and the bears will take profits, and both sides will see the two-legged pullback and wonder if the bull trend will resume. At this point, the wedge has played itself out and the market will be looking for the next pattern. Why do so many reversals occur after a trend channel line overshoot when everyone knows that it commonly leads to a reversal? Won't early entrants prevent the line from ever being reached? Common wisdom is that novice traders on the wrong side hold their losing positions until they cannot stand any more pain, and then suddenly all of them exit at once, creating a blow-off or a parabolic climax. For example, in a bull channel, the market works its way up to some resistance level, even if it is not very apparent or impressive, and pokes through it, causing the last shorts to no longer be willing to take the pain. They suddenly give up. As soon as these last shorts cover in unison, many euphoric, inexperienced bulls see the upsurge and buy into it, adding to the sudden, sharp move that breaks above the trend channel line. This spike up causes more remaining shorts to cover, and the impressive upsurge causes more naive bulls to initiate new longs, with the process feeding on itself. But then there are not enough shorts left who will cover and move the market higher, and those euphoric bulls who were trading on emotion rather than logic will panic when the market suddenly stops accelerating up, pauses, and starts to turn down. They suddenly realize that they bought at the high of a possible climax and will be quick to exit. With no more buyers left and with trapped new longs panicking to sell out of their positions, the market suddenly becomes one-sided and dominated by sellers so that it can only go down. That is the conventional logic, and it is not important whether it is true. In fact, it is likely not a meaningful component of a reversal in a huge market like the E-minis where institutions dominate, and most of the trading is probably computer-generated. Smart traders won't trade countertrend until either there is a pullback from a strong trend line break or there is a reversal from a trend channel line overshoot. For example, in a bull trend, smart money will keep buying until they drive the price above the bull trend channel line, and then they will take profits. There may be a couple of failed attempts to reverse, and the market may continue to rally at an accelerated pace, creating steeper trend channel lines. Incidentally, if you find yourself redrawing trend channel lines repeatedly, this is usually a sign that you are on the wrong side of the market. You are looking for a reversal, but the trend keeps getting stronger. You should be trading with the trend instead of intensely looking for a reversal. Eventually, the market will agree on which trend channel line is the final one, and you will see a convincing reversal. Be patient and trade only with trend until then. Never trade against the trend until it has clearly reversed. At the same time as the profit takers are taking profits, many will reverse and many other traders who were already flat will initiate shorts. Other smart traders will wait for a reversal on the charts, and there will be traders entering on reversals on all types of charts, 1 to 5 minute, and volume charts and tick charts of any size. Once they believe that the top is in, this smart money won't be looking to buy any longer. They are short, and most of these traders will hold through a new high, despite an open loss on their current position, believing that the top is in or close to in. In fact, many will add on above the high, both to get a better average price for their shorts and to help push the market down. The big players are only thinking short and won't be scared out except by the rare occurrence of a failed second entry or a huge failure, for example, maybe 3 points above their entry in the E-mini. There are no buyers left, so the market only has one way to go. Although you do not need to look at volume when deciding whether to place a trade since it is so unreliable, it is often huge at key turning points, especially at bottoms. Every trade is between one or more institutions buying and one or more selling. The major buyers at a market bottom are the profit-taking bears and the new longs. Why would a firm ever sell at the bottom tick of a bear market? Every firm uses strategies that they have carefully tested and found to be profitable, but all lose money on 30 to 70% of their trades. The firms selling at the low tick are the ones who were selling at the low tick all the way down in the bear, making profits on many of their earlier entries, and they simply continue to use those strategies until it is clear that the trend has reversed. So yes, they lose on that short at the final low tick of the bear, but make enough from all of their earlier shorts to end up profitable. There are also HFT firms that will scalp for even a single tick right down to the low tick of the bear. Remember, the low is always at a support level, and many HFT firms will short a tick or two above support to try to capture that final tick, if their systems show that this is a profitable strategy. Other institutions sell as part of a hedge in another market: stocks, options, bonds, currencies, etc., because they perceive that their risk/reward ratio is better if they place the hedge. The volume is not from small individual traders, because they are responsible for less than 5% of the volume at major turning points. The reversal at an overshoot happens because it is such an entrenched part of institutional trading psyche that it has to happen. Even if institutions do not look at charts, they will have some other criterion that tells them that the market has gone too far and it is time to exit or reverse, and this will invariably coincide with what price action traders are seeing. Remember, price action is the inescapable footprint of what is happening to price as a huge number of smart people are independently trying to make the most money they can in the market. In a big market, the price action cannot be manipulated and will always be basically the same. One final minor observation is that the slope of the final flag of a trend often provides an approximation of the slope of the new trend. This has limited value to a trader because there will be other much more important factors involved in the decision leading up to placing a trade, but it is an interesting observation. A trend channel line points in the direction of the trend, but is on the opposite side of the trend from the trend line. Extend it to the right and watch how the price acts when it penetrates the channel line. Does it reverse or does the trend accelerate, ignoring the line? Trend channel lines are commonly drawn in one of two ways. The first way is to draw it as a parallel line, dashed lines in figure 14.1 of a trend line, solid lines. Drag it to the opposite side of the action, and place it to touch a swing point located between the two bars used to create the trend line. Choose the point that will result in all of the bars between the trend and channel lines being contained between the lines. The second type, dotted lines in figure 14.1 of a trend channel line, is drawn across swing points and is independent of any trend line. You can also simply draw a best fit, but these are usually not helpful in trading. The slope of the final flag of the bull trend provided direction for the subsequent bear trend in figure 14.2. A linear regression trend line drawn between bars 1 and 2 became a rough bear trend channel line for the sell-off that extended into the next day. It is possible that it contributed to the buying at bar 7, but bar 7 was a buy simply based on the break of the trend line drawn over the first hour of trading, and the second attempt to reverse the breakout below the bar 5 low of the open. It is usually far better to place orders based on the most recent price action if it provides a justification for a trade than to look back 30 or more bars. In hindsight, the bull trend effectively ended at bar 1, even though the market made a higher high after bar 2. The move down to bar 2 was the first leg down in the bear channel. Deeper discussion of this chart. The market was in a bear channel in figure 14.2 for the final couple of hours of yesterday, so the odds of a successful first attempt to reverse upward were not great. The breakout below the trend channel line reversed up with the first bar of the day, which was a bull trend bar, but the failed breakout went only a few bars before setting up a breakout pullback short. In figure 14.3, the trend line from bars 2 and 3 was used to create a parallel that was dragged to bar 1 and extended to the right. This trend channel line was not penetrated by bar 6. Also, it was anchored to bar 1, which was not in between bars 2 and 3, the bars used to create the original trend line. However, traders should always be looking at every possibility. Had there been a penetration and reversal, the chances of a two-legged rally off the bar 5 low would have been improved. The simple trend channel line created from the bars 1 and 5 lows was penetrated by bar 6, but this was not an ideal trend line to use as a basis for a counter-trend trade since bars 1 and 5 were far apart and bars 5 and 6 were close together. Trend lines work best when they are tested by a third leg. Here, bars 5 and 6 were essentially still part of the same leg, 3 pushes down, bars 4, 5, and 6. The trade was still worth taking because bar 6 was small, so the risk/reward ratio was good. This was also a shrinking stair pattern down, discussed later, but it is a series of lower lows where each successive breakout is smaller than the prior one, which indicated waning bearish momentum and supported a long, deeper discussion of this chart. The large gap down in figure 14.3 was a breakout, as all large gaps are, and the day started as a trend from the open bear day. The small opening range put the market in breakout mode, and there was a large bear breakout bar. However, an unusually large bear trend bar forming after a bear trend has gone a long way usually is a sell climax that will be followed by at least a two-legged sideways to up correction that lasts at least 10 bars. Bar 1 was a strong bull reversal bar that set up the failed breakout long. There was a two-legged sideways correction that ended with the bar 3 failed breakout of a tight trading range, and it formed an approximate double top with bar 2. Even though most of the trading was sideways, the day still opened near its high and closed near its low. This was a trending trading range day with upper and lower trading ranges. Chapter 15. Channels. When trading is mostly confined to between a pair of lines, it is in a channel. The market is always in some kind of channel if you look hard enough to find one, and it usually is simultaneously in several, especially if you look at other time frames. A trend channel is a channel that is diagonal and is contained by a trend line and a trend channel line. For example, a bear channel has a descending trend line above a bear trend line and a descending trend channel line below a bear trend channel line. A trading range is contained between a horizontal support line below and a resistance line above. Sometimes a trading range can be slightly rising or falling, but if so, it is better to think of it as a weak trend channel. Triangles are also channels, since they are areas of price action contained between two lines. Since they have either higher highs or lower lows, or both in the case of an expanding triangle, they have some trending behavior in addition to their trading range behavior. An expanding triangle is contained between two diverging lines, both of which are technically trend channel lines. The line below is across lower lows, so it is below a bear trend and therefore a trend channel line, and the line above is across higher highs and therefore a bull trend channel line. A contracting triangle is contained between two trend lines, since the market is both in a small bear trend with lower highs and a bull trend with higher lows. An ascending triangle has a resistance line above and a bull trend line below, and a descending triangle has a support line below and a bear trend line above. A wedge is an ascending or descending channel where the trend line and trend channel line converge, and it is a variant of a triangle. An ABC correction in a bull trend is a small bear channel, and when it is in a bear trend, it is a small bull channel. Though the moving average often functions as support or resistance in a strong trend, and many traders create curved channels and bands based on the moving average and many other factors, straight trend lines and trend channel lines consistently provide more reliable setups and profitable trades. A bull channel can be in a trading range, a bull trend, a bear trend, or at a possible bottom of a bear trend as the market begins to reverse up. When it is in a trading range, traders can consider buying when in the lower half of the range, but the odds of success become less as the channel progresses into the upper half of the range. When a channel is in a bull trend, higher prices are more certain, and traders should look to buy near the bottom of the channel. The chance of a successful long remains good until the channel begins to have prominent selling pressure, or until it approaches significant resistance. When a channel is especially tight, meaning that the trend line and trend channel lines are close together and the pullbacks are small, it is a sign that the trend is strong, and it can be a spike on a higher time frame chart. A broader channel may follow, which might reach a measured move target based on the height of the tight channel. A channel that is so tight that it has no pullbacks or only one or two tiny pullbacks is a micro channel, which is discussed in the next chapter. When a bull channel forms in a bear trend, it is a bear flag, and traders should look to short near the top or on the pullback from a downside breakout. Sometimes when a bear trend begins to reverse up, the first 5 to 10 bars are in a weak bull channel, with lots of overlapping bars and one or more attempts to break below the bear flag, but these fail and quickly reverse up. After a failed low 2 or low 3, the market then sometimes breaks out to the upside from the bear flag. The market suddenly becomes always in long, and a bull reversal begins. When traders suspect that a bear flag might be the start of a bull trend, many will buy below the low 1, 2, or 3 signal bars, expecting them to fail and for the market to reverse up. As a channel is forming, traders are uncertain if there will actually be a channel or just a two-legged move, and then a reversal. In fact, you usually cannot even draw channel lines until after the market begins to reverse from the two-legged move and the reversal fails, and the third leg begins. For example, if the market just completed two legs up and has started to reverse, many traders will short the reversal if the rally is not a strong bull trend. However, if the leg down ends and is comparable in size to the first leg down the leg after the first leg up, and then it reverses up again, traders will now begin to assume that a bull channel is underway rather than a reversal down into a bear leg. Once that second leg ends, traders will draw a trend line from the bottom of the first leg down to the bottom of this second leg and extend it to the right. They will look to buy whenever the market again comes back to the trend line. They will also create a parallel of the line and drag it to the top of the first leg up, and this is their first creation of a channel. Whenever the market rallies up to that trend channel line, traders will take profit on their longs and look to short. Since a bull channel needs at least those first two legs down to confirm the existence of the channel, and the market will usually then test above the top of the second leg up, bull channels usually have at least 3 pushes up. Traders will usually not look for a reversal and a downside breakout of the channel until after that third leg up forms. However, once it does, especially if there is an overshoot of the trend channel line and a strong bear reversal bar, traders will short aggressively because the odds of a successful downside breakout have increased. Because of this, many bull channels end after a third push up. Likewise, many bear channels end after a third push down. Why does the market race toward the top and bottom of the channel? This is because of a vacuum effect. For example, if there is a bull channel and there is a leg that is approaching the trend channel line above, the traders believe that the market will likely touch that line and may even go a tick or two above it. Since they believe that the market will go at least a little higher than it is right now, they will hold back on their selling. The bulls want to sell out of their longs eventually to take profits, and the bears want to sell to initiate new shorts. The current relative absence of selling creates a buy imbalance, and whenever there is any imbalance, the market moves quickly. The result is that there is often a large bull trend bar or two that form as the market tests the top of the channel. This often attracts overly eager bulls to buy at the top of the spike, since they think the market is forming a new, stronger bull leg. However, most breakout attempts fail, and this one will likely fail as well. Why? Because of the institutional traders. The strong bears want to short, but they believe that the market will touch that upper trend channel line, so they wait. Once the market is there, they short heavily and overwhelm the bulls. I like to see a strong bull trend bar, because they believe that the market will go lower, and there is no better price to short than at the point of maximum bullishness. The market might pause for a small bar at the top of the bull trend bar as both the bulls and the bears decide if the breakout will fail, but it will usually then quickly fall since both the institutional bulls and bears know that the odds are strongly in favor of all breakout attempts failing. So what do those strong institutional bulls do? They stop buying and they quickly sell out of their longs, capturing a brief windfall profit. They know that this opportunity will likely be brief because the market does not stay at an extreme for long, so they exit and they won't look to buy again for at least a bar or two. The relative absence of these institutional bulls and the aggressiveness of the institutional bears force the market down quickly to the bottom of the channel, where the opposite process begins. Both the bulls and the bears expect the trend line below to be tested. The bears will keep shorting until the market gets there, and then they will buy back their shorts as they take their profits, and the bulls won't buy until the market gets there. This creates a brief, sharp move down that will entice beginning traders into shorting, expecting a bear breakout, but they are doing the exact opposite of the institutions. Remember, your job is to follow what the institutions are doing. You should not be doing what you hope they will soon do, and you should never do the exact opposite of what they are doing. Each of these small pullbacks is a micro-sell vacuum. Once the market gets close to the bottom of the channel, both the bulls and the bears expect the market to reach the bull trend line and they stop buying until it gets there. Once there, the bulls buy to initiate new longs and the bears take profits on their short scalps. Both expect a new channel high and a test of the top of the channel, where the process begins again. This takes place in all channels, including in trading ranges and triangles. Even in a trend channel, there is two-sided trading taking place, and this is trading range behavior. In fact, A trend channel can be thought of as a sloping trading range. When the slope is steep and the channel is tight, it behaves more like a trend, and trades should be taken only in the direction of the trend. When the slope is less steep, and there are broad swings within the channel, some lasting 5 or even 10 bars, the market is behaving more like a trading range and can be traded in both directions. As with all trading ranges, there is a magnetic pull in the middle of the trading range that tends to keep the market in the range. Why does the market stay in a channel and not suddenly accelerate? Because there is too much uncertainty, like with all trading ranges. For example, in a bull channel, the bulls want to buy more but at a lower price. The weak shorts want to sell off so they can exit with a smaller loss. Both the bulls and the weak bears are concerned that there may not be a pullback that will allow them to buy all of the shares that they want to buy. The weak shorts are buying back their losing short positions at a better price. So they continue to buy in pieces as the market goes up, and this adds to the buying pressure. Buy even more aggressively on any small dip, like with a limit order below the low of the prior bar or at the moving average or near the trend line that forms the bottom of the channel. In general, when a channel is beginning, it is better to trade with the trend, and as it is approaching a target area, and as it develops more two-sided trading, experienced traders will often start trading countertrend. So at the start of a bull channel, it is better to buy below the lows of bars. But as the channel reaches resistance areas and starts to have more overlapping bars, bare bars, deeper pullbacks, and prominent tails, it is better to consider shorting above bars instead of buying below bars. However, for traders just starting out, whenever they see a channel, they should trade only with the trend, if at all. Trading channels is very difficult because they are always trying to reverse and have many pullbacks. This is confusing to beginning traders and they often take repeated losses. If there is a bull channel, they should only look to buy. The most reliable buy signal will be a high 2 with a bull signal bar at the moving average where the entry is not too close to the top of the channel. This kind of perfect setup does not occur often. If traders are just starting out, they should wait for the very best setups, even if that means missing the entire trend. More experienced traders can buy on limit orders below weak sell signals and near the moving average and near the bottom of the channel. If traders are not consistently profitable, they should avoid taking any sell signals in a bull channel, even if there is a small lower high. The market is always in long and they should not be looking to short, even though there will be many signals that look acceptable. Wait for the market to become clearly always in short before looking to short. That will usually require a strong bear spike that breaks below the channel and below the moving average and has follow through, and then has a lower high with a bear signal bar. If the setup is any weaker than that, beginners should wait and only look to buy pullbacks. Do not fall into the regression toward the mean mindset and assume that the channel looks so weak that a reversal is long overdue. The market can continue its unsustainable behavior much longer than you can sustain your account as you bet against that very weak-looking trend. Many bulls will be scaling into their long positions as the market goes up, and they will be using every conceivable logical approach to do this. Some will buy on a pullback to the moving average or below the low of the prior bar, or on pullbacks at fixed intervals, like every 50 cents below the most recent high in Apple. Others will buy as the market appears to be resuming the channel up, like every 25 cents above the prior low. If you can think of an approach, so can some programmer, and if she can show that it is effective mathematically, her firm will probably try trading it. With both the bulls and trapped bears wanting lower prices but afraid that they will not come, both continue to buy until they have nothing left to buy. This always happens at some magnet like a measured move, or a higher time frame trend line or trend channel line. Since channels usually go much further than what most traders expect, the trend usually continues up beyond the first one or more obvious resistance levels, until it reaches one where enough strong bulls and bears agree that the market has gone far enough and will likely not go much higher. At that point, the market runs out of buying pressure and the strong bulls take profits and sell out of their longs, and the strong bears come in and sell more aggressively. This results in a reversal into a deeper correction or into an opposite trend. The bull trend often ends with a breakout of the top of the channel as the last desperate bears buy back their shorts in despair, and the weakest bulls who have been waiting and waiting for lower prices finally just buy at the market. The strong bears expect that, and will often wait for the strong breakout and then begin shorting relentlessly. They believe that this is a brief opportunity to short at a very high price, and that the market won't stay here for long. The strong bulls see the spike up as a gift, and they exit their longs and will now buy again, only after at least a two-legged pullback lasting at least 10 bars. They often will not buy until the market gets down to the beginning of the channel, where they originally bought into a profitable trade. The strong bears know this and will look to take profits exactly where the strong bulls will be buying again. The result usually is a bounce, and then often a trading range as both sides become uncertain about the direction of the next move. Uncertainty usually means that the market is in a trading range. Or at least that is the conventional logic, but it is probably more complicated, sophisticated, and unknowable. All institutions are familiar with this pattern, and you can be certain that their programmers are constantly looking for ways to capitalize on it. One thing an institution might do is try to create a buy climax. If it has been buying all the way up and is ready to take profits, but it wants to be sure that the top is in, it could suddenly buy a final big piece with the realization that it might even take a small loss on it, but with the goal of creating a climactic reversal on the charts. If the firm is successful, and it might be if several other institutions are running programs that are doing similar things, it can exit all of its longs, most with a profit, and then even reverse to short, confident that the sellers now control the market. Does this happen with every climax? It is unknowable and irrelevant. Your goal is to follow what the institutions are doing, and you can see it on the charts. You never have to know anything about the programs behind the patterns, and the institutions themselves never know what types of programs the other institutions are running. They only know their own programs, but the market rarely goes far unless many institutions are trading in the same direction at the same time, and they have to be trading with enough size to overwhelm the other institutions that are doing the opposite. The only time that the vast majority of the institutions are on the same side is during the spike phase of a strong trend, and that occurs in fewer than 5% of the bars on the chart. It is not just bulls and weak shorts who are placing trades as the channel continues up. Strong shorts are also selling as the market moves higher, scaling into their positions, believing that the upside is limited and ultimately their trade will be profitable. Their selling begins to create selling pressure in the form of more bars with bare bodies, larger bare bodies, tails on the tops of the bars, and more bars with lows below the low of the prior bar. They are looking for a downside breakout of the channel and maybe even a test to the beginning of the channel. Since they want to short at the best possible price, they are selling as the market is going up rather than waiting for the reversal. This is because the reversal might be fast and strong, and then they would end up shorting much further below the top of the channel than they believe is likely to be profitable. They have several ways to add to their short position, like selling on a limit order above the high of the prior bar or above a minor swing high in the channel, at every test of the top of the channel at the trend channel line, at measured move targets, at a fixed interval as the market goes up like every 50 cents higher in Opal, or on each potential top. Once the market reverses, they might hold their entire position with the expectation of a significant reversal, or they might exit at a profit target, like on a test of the trend line at the bottom of the channel, or even at the entry price of their first short, which is often near the start of the channel. If they do that, their first entry will be a break-even trade and they will have a profit on their higher entries. If you are scaling into shorts in that bull channel, it is best to do this only in the first 2/3 of the day. You do not want to find yourself heavily short in a bull channel with your break-even entry so far below that you don't have enough time left to get out without a loss, never mind with a large profit. In general, if you are trading a channel in the second half of the day, it is far better to only trade with the trend, like buying below the low of the prior bar or above every bull reversal bar at the moving average. If the market continues higher than the shorts believe is likely, they will buy back their entire position at a loss, and this is probably a significant contributor to the climactic upside breakout that sometimes comes at the end of a channel. They no longer expect a pullback anytime soon that would allow them to buy at a better price, and instead buy at the market and take losses on all of their short entries. Since many are momentum traders, many will switch to long. All the momentum trading bulls will aggressively buy as the market accelerates upward because they know that the math is on their side. The directional probability of the next tick being higher and not lower is more than 50%, so they have an edge. Even though the breakout might be brief and the reversal sharp, their buy programs will continue to buy as long as the logic supports doing so. However, this is like musical chairs. As soon as the momentum music stops, everyone quickly grabs a chair, which means that they exit their longs very quickly. As they are selling out of their longs, there are aggressive bears shorting as well, and this can create a strong imbalance in favor of the bears. If the bears take control, the sell-off will usually last at least 10 bars, and there will usually be a reversal back below the trend channel line and into the channel, and then a breakout of the downside of the channel. The television pundits will attribute the sharp upside breakout to some news item, and there are always many to choose from, because they see the market only from the perspective of a traditional stock trader who trades on fundamentals. They don't understand that many things that happen, especially over the course of an hour or so, have nothing to do with fundamentals, and are instead the result of large programs doing the same thing at once with no regard for the fundamentals. Once the market quickly reverses on the climactic blow-off, they move on to the next story. They never address the fact that they just gave a report that was foolishly naive, and they remain completely oblivious to the powerful technical forces that drive the market in the short run. Every few years, there is an exceptionally huge intraday move, and that is pretty much the only time that they will acknowledge that technical factors were at work. In fact, they invariably blame it on programs, as if the programs suddenly briefly appeared. There is nothing to blame. The vast majority of all intraday price movement is due to programs, yet the reporters don't have a clue. All they see are earnings reports, quarterly sales, and profit margins. Since a channel is a sloping trading range, just like with other trading ranges, most attempts to break out of either the top or the bottom fail. Yes, one side is stronger, but the principle is the same as for any trading range. For example, in a bull channel, both bulls and bears are active, but the bulls are stronger, and that is why the channel is sloping up. Both the bulls and the bears are comfortable placing trades in the middle of the channel, but when the market gets near the top of the channel, the bulls become concerned that the upside breakout will fail. And as soon as they think that a failure is likely, they will sell out of some of their longs. Also, the bears were comfortable shorting in the middle of the channel and will short even more aggressively near the top, at a better value. When the market gets near the bottom of the range, the bears are less interested in shorting at these lower prices, and the bulls, who were just buying moments ago at higher prices, will buy even more aggressively here. This leads to a bounce up off of the trend line. The market usually pokes below the channel one or more times as it is forming, and you have to redraw the trend line. The result is usually a slightly broader and flatter channel. Ultimately, the downside breakout will be strong enough to be followed by a lower high and then a lower low, and when that happens, traders will begin to draw a bear channel, even if the bull channel still exists, albeit much wider. It is important to realize that most bull breakouts of bull channels fail. If the bulls are able to create a bull breakout and they can overwhelm the bears, they usually will be able to do so for only a few bars. At that point, the bulls will see the market as too overdone and will take profits. They won't want to buy until the market has corrected for a while. The magnetic effect of the middle of the channel will usually pull the market back into the channel and cause the breakout to fail, making the breakout a buy climax. Once back in the channel, the market usually pokes through the bottom of the channel as its minimum objective. The buy climax usually leads to a two-legged correction that lasts about 10 bars and usually breaks below the channel. Once the downside breakout happens, if the selling continues, the next objective is a measured move equal to about the height of the channel. The bears also know that the buy climax will likely be followed by a correction, and they will short aggressively. With the bulls selling out of their longs, there is strong selling pressure and the market corrects down and can even become a bear trend. Sometimes an upside breakout of a bull channel is strong and does not fail within a few bars. When this is the case, the market will usually rally to a measured move target, and the breakout will become a measuring gap. For example, if the bull channel has a wedge shape and breaks to the downside, but the downside breakout fails within a few bars, and then the market races up and breaks above the top of the wedge, the rally will usually reach a measured move up that is equal to about the height of the wedge. The trend bar or bars that break above the wedge then become a measuring gap. Gaps, measured moves, and breakouts are discussed in Book 2. If instead of an upside breakout, there is a downside breakout, but without a failed upside breakout, by climax and bear reversal, the market usually goes sideways for a number of bars. It may form a lower high and then a second leg down, or the trading range might become a bull flag and lead to a resumption of the bull trend. Less commonly, there is a strong spike down and a strong bear reversal. The opposite of all of this is true for bear channels. Since a trend channel is simply a sloping trading range, it usually functions like a flag. If there is a bull channel, no matter how steep or protracted, it usually will have a downside breakout at some point and therefore can be thought of as a bear flag even if there was no bear trend preceding it. At some point, the strong bulls will take profits, and they will be willing to buy again only after a significant pullback. That pullback often has to go all the way to the beginning of the channel, where they began buying earlier. And this is part of the reason why channels often lead to a correction all the way to the bottom of the channel, where there is usually a bounce. The strong bears are as smart as the strong bulls, and generally just when the strong bulls stop buying, the strong bears begin to aggressively short and will not be shaken out higher. In fact, they will see higher prices as an even better value and they will short more. Where will they take profits on their shorts? Near the bottom of the channel, just where the strong bulls might try to re-establish their longs. Because a bull channel behaves like a bear flag, it should be traded like a bear flag. Similarly, any bear channel should be viewed as a bull flag. There may or may not be a bull trend that precedes it, but that is irrelevant. Sometimes there will be a higher time frame bull trend that might not be evident on the 5-minute chart, and when that happens, the bear channel will appear as a bull flag on that chart. Although a higher time frame trend might increase the chances of a bull breakout and the chances that the breakout will be strong and go further, you will so often see huge bull breakouts from bear channels that it is not necessary to look for a higher time frame bull trend to trade the channel like a bull flag. The opposite is true of bull channels, which are functionally bear flags. Since a bull channel is a bear flag, there is usually a bear breakout eventually. Sometimes, however, there is a bull breakout above the channel. In most cases, this breakout is climactic and unsustainable. It might last for just a bar or two, but sometimes it lasts for 5 or more bars before the market reverses down. Less often, the bull trend will continue in a very strong trend. If it reverses, it usually re-enters the channel, and with any channel breakout that re-enters the channel, it usually tests the opposite side of the channel. After a failed breakout of the top of a bull channel, since this is a type of climax, the reversal should have at least 2 legs down and last at least 10 bars, and it often becomes a trend reversal. The opposite is true of a downside breakout of a bear channel. It usually is a sell climax and reverses back above the channel and has at least 2 legs up. All channels eventually end in a breakout, which can be violent or have very little momentum. Trend channels usually last much longer than what most traders suspect, and they often trap traders into prematurely taking reversal trades. Most channels usually have at least 3 legs before they end. This is especially clear in triangles and in wedges in particular. With triangles, the breakout is usually imminent, but the direction is often not clear. The steeper the slope and the closer together the lines are, the stronger the channel is and the stronger the momentum is. When a channel is steep and tight, it is a special type of channel called a tight channel. When it is horizontal, it is a tight trading range, which is discussed in Book 2. When a channel is strong, it is risky to trade the first breakout against the trend, and it is likely that the entire channel will be a spike on a higher time frame chart. So if there is a steep bear channel, and most of the pullbacks within the channel have been only a single bar, it is better not to buy one of those breakouts above the prior bar, even if it breaks above the bear trend line. Instead, it is better to wait to see if there is a breakout pullback, which can be a lower low or a higher low. If there is and the reversal up looks strong, for example, maybe there were 2 or 3 good-sized bull trend bars within the past several bars, then you can consider buying the breakout pullback. If there is no pullback and the market races upward, then the odds of even higher prices are good and you can wait for any pullback, which should come within 5 bars or so. The odds of the long being profitable are better if the rally up goes above the moving average and that first pullback stays above the moving average. This is a sign of strength. If the first pullback forms below the moving average, the bulls are weaker, and the chance of a second leg up is less. If the market continues to sell off after the upside breakout, the breakout failed and the bear trend is resuming. The strength of a channel is especially important when the market might be in the process of reversing. For example, if there is a strong bull trend and then there is a strong sell-off that breaks well below the bull trend line, traders will study the next rally carefully. They want to see whether that rally will simply be a test of the bull high, or will instead break out strongly above the high and be followed by another strong leg up in the bull trend. One of the most important considerations is the momentum of that test of the bull high. If the rally is in a very tight, steep channel with no pullbacks and very little overlap between the bars, and the rally goes far above the bull high before having any pause or pullback, the momentum is strong and the odds are increased that the bull trend will resume, despite the strong sell-off and breakout below the bull trend line. Usually the first breakout of a tight, prolonged channel will fail. The trend will then resume and often break out to a new extreme and reach a measured move equal to about the height of that initial breakout. By contrast, if the rally has many overlapping bars, several large bear trend bars, 2 or 3 clear pullbacks, maybe a wedge shape, and a slope that is noticeably less than the slope momentum of the original bull trend and of the sell-off, the odds are that the test of the bull high will result in either a lower high or a slightly higher high, and then another attempt to sell off. The market might be reversing into a bear trend, but at a minimum a trading range is likely. Whenever there is a breakout of any channel and then a reversal back into the channel, the market will try to test the other side of the channel, and will usually try to break out of it, at least by a little. If there is a successful breakout of the channel in either direction, the next minimum objective is a measured move equal to about the height of the channel. For example, a double top is a horizontal channel, and if there is a successful breakout of the downside, the minimum target is a measured move equal to the height of the channel. However, the breakout can become a trend reversal, and the move can be much greater. If instead the breakout is to the upside, the target is again a measured move up equal to the height of the double top. If Opal is forming a double top, and the top of the pattern is $5.00 above the bottom, the initial target of any breakout to the upside is $5.00 above the top. If the breakout instead is to the downside, the initial objective is $5.00 below the low of the pattern. The same is true for a wedge bottom. The first objective is a test of the top of the wedge. If the market continues up, the next target is a measured move up. If the rally continues, the market might then be in a bull trend. Even when a channel is sloping, the initial objective is a move equal to the height of the channel. In a bull channel, for example, pick any bar and look at the channel lines directly above and below. Simply measure how far apart they are to get the measured move projection. The measured move targets are only approximate, but the market often hits them exactly and then pauses, pulls back, or reverses. If the market goes much beyond the target, a new trend is likely underway. As with all breakouts, 3 things can then happen. It can be successful and be followed by more trading in that direction. It can fail and become a small climactic reversal, or the market can just go sideways and the pattern can evolve into a trading range. Most breakouts have an attempt to reverse within a few bars. If the reversal bar is strong compared to the breakout bar, the odds of a failed breakout and a successful reversal are good. If the reversal bar is weak compared to the breakout, the odds are that the reversal attempt will fail and set up a breakout pullback within a bar or two, and the breakout will resume. If the breakout and the reversal are about equally strong, traders will then look at the bar after the reversal signal bar. For example, if there is a strong bull trend bar that breaks out of a bull flag, and the next bar is an equally impressive bear reversal bar, the bar that follows becomes important. If it trades below the bear reversal bar, the breakout has failed, at least for the moment. If it then has a strong bear close and is a strong bear trend bar, the chance that the reversal will continue down increases. If instead it is a strong bull reversal bar, chances are that the failed breakout will not succeed, and this bull reversal bar then becomes a signal bar for a breakout pullback buy at 1 tick above its high. Breakouts are discussed in Book 2. Channels are common on all charts, and some smaller channels are nested inside of larger channels. In Figure 15.1, notice that the lines do not always have to be drawn to contain all of the highs and lows in the channel. Drawing them with best fit lines helps to make the channel behavior clearer and often makes it easier to anticipate signals. Since most trading is institutional and placed by computer programs, it is reasonable to assume that each small, tight channel is due to program trading. Since there are so many firms running programs all day long, a channel probably can develop only when several firms are running programs in the same direction, and with enough volume to overwhelm the programs that are trying to make the market move in the opposite direction. For example, in the channel down from bar 4, there were enough sell programs going on to overpower any buy programs, and the market moved down. When the buy and sell programs are largely in balance, the market moves sideways in a tight trading range, which is a horizontal channel. Bull channels are indistinguishable from bear flags, and bear channels should be thought of as bull flags. When the channel is tight like from bars 2 to 3, buyers should wait until there is a failed breakout and reversal up before looking for longs, as occurred at bar 3. They could also wait for a pullback after the breakout, like the buying above the high of the small bar that formed 5 bars after bar 3. Until either of these develop, traders should only be shorting. When a channel has broader swings like the channel from bars 3 to 8, trades can be taken in both directions, since it more clearly resembles a sloping trading range, and trading ranges are two-sided markets that give both buy and sell signals. Most of the channels in the chart were tight, and since several had no pullbacks or small, only 1 to 3 tick 1-bar pullbacks, and lasted about 10 bars or less, they were also micro channels. When there is a breakout of a channel, and then a reversal back into the channel, the market usually tests the opposite side of the channel and often breaks out of the other side, at least minimally. If the breakout has follow-through, the first target is a measured move equal to the height of the channel. In Figure 15.2, bar 3 broke out of the top of a trading range and reversed back down. After breaking through the bottom of the channel, the bar 4 low was 1 tick below a perfect measured move. Bar 11 broke above the top of a trading range, and then the market tested the bottom of the range with bar 13. Sometimes, there are several bars to choose from when drawing the lines, and it is usually worth being aware of all of the possibilities because you may not know which is best until several bars later. The widest channel is the most certain. The bull inside bar that followed the bar 13 breakout set up a failed breakout buy. Since the market was again reversing into the channel, the first target was a test of the top of the channel. The breakout of the top was successful, and the next target was a measured move up. Bar 22 went 1 tick above that target. Sometimes a trend will begin and carry much further. Bar 17 broke above a bull micro channel or wedge and reversed back down on the next bar. Since the channel was so tight, the objective of testing the lower end of the channel was met on that next bar, but there was not enough room for a profitable short, and no trade should be taken. The measured move up for the breakout of the channel formed by bars 19 and 20 was at the same price as the measured move up from the trading range defined by bars 6 and 10. When multiple targets are around the same price, any reversal there has an increased chance of success. Bar 21 was a valid short setup, but it failed on the bar after entry. There was a second entry below bar 22, and the market tested the bottom of the channel. There, it formed a bull reversal bar, and the market then tested the top of the channel. Deeper discussion of this chart. The market broke below a closing trading range with a large gap down in Figure 15.2, but the first bar was relatively large and had good-sized tails above and below. This is trading range behavior, and not a good signal bar for a trend from the open buy or short. The second bar was a strong bull reversal bar, and signaled a long for a failed breakout and a trend from the open bull trend. The market entered a tight trading range just below the moving average, and it became a final flag with a failed breakout and reversal down. Although traders could short as soon as bar 3 went below the low of the prior bar, it was safer to wait until the bar closed to confirm that it would have a bear body, and then short below its low. The rally to bar 1 was in a micro channel, so the bar 2 downside breakout was likely to not go very far without a pullback. When the market moved above the high of the bar 2 breakout bar, the breakout failed. At that point, the market went sideways as traders fought for control. The bears were looking for a higher high or lower high pullback from the bar 2 breakout, and the bulls simply wanted a failed breakout and then another leg up. The bears won and the market fell in a micro channel down to bar 4, where the process reversed. Bar 5 was the signal bar for the failed breakout, but the 4-bar bull spike was strong enough for traders to believe that the market would likely test higher, which it did in the move up to bar 8. The move from bar 14 to bar 17 was another bull micro channel, and bar 18 was the breakout. The market then went sideways before the small trend resumed in the move up to bar 22. A bull channel can occur in any type of market. In figure 15.3, the 5-minute E-mini chart on the left had a bull channel in a strong bull trend, where the market gapped up and became a trend from the open bull trend day. The pullbacks were small, and the market worked higher all day. Because the day was a strong bull trend day, traders were buying small pullbacks, like at and below the low of the prior bar. The bull channel in the middle chart was a wedge bear flag in a bear trend, and traders should not have been looking for longs. They could have shorted below the Roman 2 pattern at bar 18 or on any of the several following bars, as the market became always in short. The bull channel on the right was a small bear flag in an overdone bear trend. It formed after the large bear trend bar on the open, which was the third push down. Bar 26, see insert, set up a strong 2-bar reversal up from yesterday's low. Even though the channel from bar 26 to the bar before bar 29 was a bear flag, traders believed that the market was reversing up and bought below the lows of the prior bars, expecting the low 1 and low 2 sell setups to fail. Bar 29 was a strong bull trend bar that broke out of the top of the bear flag and turned the market into a clear always-in long. Not all bear flags break out to the downside. Some become the final flag of the bear trend, break out to the upside, and lead to a bull trend, as happened here. When the market successfully breaks out of any channel, the first target is a measured move. In figure 15.4, a weekly chart of the SPY, the trend line was drawn across the lows of bars 1 and 4, and the trend channel line drawn from the highs of bars 2 and 3 was touched at bar 5. This is a bull channel, and the lines are slightly convergent. Horizontal line is across the bar 5 high, and line B is the bottom of the channel directly below bar 5. Line C is a measured move down from lines A to B. Bar 6 found support at the measured move, and a rally followed. A similar target would have been projected using an Andrews pitchfork, but since basic price action analysis gives the same result, it is all that you need. There were probably countless reasons why bears were taking profits around the bar 6 low and why aggressive bulls were buying. None of them is important since there is never any way to know how many dollars are being traded for each reason. All that you know is that the chart is the distilled result of all of those dollars being traded for countless reasons, and understanding recurring patterns puts you in a position to know when to take profits and when to consider reversal trades. The move down to bar 1 was the first breakout below a tight, strong bull channel and was therefore likely to fail. When a first breakout fails and the trend resumes, it often extends up to a measured move that is approximately equal to the height of that initial reversal attempt. Here, the rally extended much further. The channel that began after the bar 1 bull spike was also very tight, and the spike down to bar 4 was the first strong breakout. The reversal failed and the trend resumed. The bulls tried to extend the rally for about a measured move up. That measured move was equal to the height of bar 3 to bar 4, added to the top of bar 3, but the market did not quite reach the target. The rally to bar 7 broke above the 2-legged bull flag down to bar 6, and bar 8 was the breakout pullback. It was also the start of another bull channel, and the move down to bar 12 broke below the channel, reaching about a measured move down, based on the height of the channel, and the height of the first leg down bar 11 and the bar after it. Bars 3, 5, and 7 formed a head and shoulders top, and like most reversal patterns, became a large bull flag and not a reversal. Deeper discussion of this chart, the bar before bar 6 in figure 15.4 was a breakout pullback short setup, and a low too short at the moving average. The bar after bar 5 had a large tail, as did several of the next bars, and that trading range below the moving average was a barbed wire pattern, which often becomes a final flag, as it did here. There was a 1-bar spike up on the low of the chart, which was followed by a very tight channel. In fact, there were 3 or 4 tight channels in the rally. Some traders saw the second spike from bar 1 to bar 3 as a single steep channel or spike, and others saw it as 2. When a channel is tight, it often functions like a spike and is followed by a channel. The pullback to bar 1 was followed by a 2-bar spike, and then another channel that again was so tight that it was likely to function as part of the initial spike. After the pullback from bar 2, the channel up had several bear bodies, which was a sign of building selling pressure. The result was a strong 4-bar bear spike down to bar 4. The selling pressure was building, and bulls were likely to take profits on the test of the high. Although the channel up from bar 4 was tight and therefore possibly another spike, a spike can also function as a climax. This was the 3rd or 4th consecutive biclimax. Every spike, whether it is 1 bar or many bars, is a climax, and it followed a strong bear spike. Consecutive climaxes usually lead to a larger correction, as they did here. A bear channel that breaks out of the bottom of the channel can be followed by an even stronger bear trend, but the breakout usually soon becomes a climax and is typically followed by at least 2 legs up, as shown in figure 15.5. Bar 4 broke below the bear channel but became a sell climax, as expected, and was followed by a 2-legged rally that ended at bar 7. There was a bull spike up to bar 14 that was followed by a pullback to bar 15, and then a wedge-shaped channel developed. The market broke out to the upside on the gap up to bar 17, but this breakout was just a buy climax that reversed back into the bull channel and then broke out of the downside. The correction had 2 legs, ending at bar 18. Many channels have 3 pushes in them before reversing, and bars 14, 16, and 17 were 3 pushes up. The small bull channel that started at bar 12 broke out to the upside, and the breakout was very strong. All breakouts are climaxes, but climaxes don't always lead to reversals. Some can become very strong breakouts like this one. Once they finally finish correcting and the trend then resumes, it usually does so with less momentum, the slope is less, and there are usually more overlapping bars, which is a sign of increased 2-sided trading. When a bull trend is strong, traders will buy tests of the moving average, like at bars 13 and 15. The moving average therefore contains the trend and functions like the lower line of a channel. You can write indicators to create a parallel of the trend line and place it above the highs, creating a channel, but usually curved channel lines or bands of any type do not provide as many reliable trades as do straight channel lines. Deeper discussion of this chart. The strong move up from bar 13 to bar 14 in figure 15.5 was almost vertical, and all strong bull breakouts should be thought of as spikes up and as biclimaxes. When the spike is composed of 2 or more large bull trend bars, it is particularly strong and more likely to have some type of measured move up before there is a significant correction. Measured moves using the open or low of the first bar of the spike and the close or high of the last bar often are good areas for the bulls to take partial or full profits, and sometimes are good areas for bears to initiate shorts. Bar 13 had no tail on the bottom and closed near its high. It was the first of many bull trend bars, so it is the bottom of the spike. The height of the spike using the open of bar 13 and the high of the bar 14 top of the spike projected a measured move up to the exact high of the channel, the bar 17 high. Bar 7 was a second entry moving average gap bar short in a bear trend, which often leads to the final leg in the bear trend before a larger reversal develops. The rally to bar 7 broke the bear trend line and was followed by a lower low trend reversal at bar 8. Bar 10 was another lower low in what at that point was a trading range, but it was also an expanding triangle bottom. Expanding triangles often rally to a new high and set up an expanding triangle top. The market attempted to do that at bar 14, but the momentum was so strong that anyone thinking about shorting would have to wait for a second entry, which never set up. It was far better to be looking to buy a pullback than to consider taking a short after such a strong bull breakout. The expanding triangle top failed, as expected, and the breakout of the top of the trend channel line and the bar 9 high of the prior day was followed by a two-legged sideways breakout pullback correction to the moving average at bar 15. Once the market appears to be trending, look for all possible trend lines and trend channel lines because they are areas where the market might reverse. Traders will use every technique to draw the lines, like connecting swing points, creating parallels, and using best fit lines. Figure 15.6 shows some of the more obvious lines, but there were many others. Some would have been based on related markets like the cash index, and others were based on other types of charts like volume and tick charts. The shorts can take partial profits on the tests of the bottom of the channels near the trend channel lines, and aggressive bulls can initiate long scalps there. At the top of the bear channel, bulls will take profits on their scalps and bears will initiate shorts for swings and scalps. A bear trend line created by the bar 3 to bar 7 high was tested to the tick 6 bars after bar 7 and again at bar 10 and bar 11, and it contained all of the upside price action. This made it clear that it was important today. Because it was important, creating a parallel line B and anchoring it at a swing low that contained all of the sell-offs would likely create a channel that traders would feel was significant. Bar 6 was the logical choice for the anchor. Once bar 14 broke below the bottom of the channel, traders would look at a measured move down using the height of the channel at the time of the breakout for a possible measured move projection. The move was exceeded on the open of the next day. When a bear channel breaks out of the downside instead of the top, even if the breakout is sharp as it was here, it usually goes only a few bars before reversing. Once it reversed back into the channel on bar 17, the objective was a poke above the channel, which occurred at bar 19. The sell-off from bar 13 to bar 16 had 10 bear trend bars with little overlap and large bodies with small tails, all signs of bear strength. This was unsustainable behavior and therefore climactic. It had to be an unusually large bear trend bar on some higher time frame chart, although nothing is gained by looking for the perfect higher time frame chart. Any large bear trend bar is a spike, a breakout, and a sell climax. The strong move up to bar 19 had to create a 2-bar reversal with that sell-off from bar 13 on some higher time frame chart, and even a bull reversal bar on an even higher time frame chart. Never lose sight of the big picture, and don't become frightened by an unusually strong sell-off. Yes, a huge bear spike is a strong sell climax and will often be followed by a protracted bear channel, but it can also represent exhaustion and lead to a big reversal, as it did here. The market usually races to the top and bottom of the channel due to the vacuum effect. For example, bar 7 was a strong bull trend bar, and there was another strong bull bar 2 bars earlier. Weak bulls saw a 3-bar spike and a strong reversal up on the day and bought as bar 7 was forming and on its close, and on the high 3 bars later. Strong bulls instead exited their longs on the test of the top of the bear channel. So why was the market vacuumed up with such force on a bear trend day when bears clearly controlled the day? It was because the bears believed that the trend line was going to get tested. So as the market got closer and closer to it, they became more confident that the price would soon reach the bear trend line. There is no incentive for them to short when they believe they can short at an even better price few minutes later. This absence of the strongest of the bears creates an updraft that sucks the market up quickly to the trend line. The momentum traders kept buying until the momentum stopped, and since there were fewer bears willing to short, the market quickly moved up to a price that represented value to the bears. Once there, the bears, who had been waiting for the test, shorted aggressively. They had been able to overwhelm the bulls all day, as seen by the bear trend day, and both the bulls and bears knew that the bears were in control. There was a bear channel, and the market was spending most of the day below the moving average. Since everyone except novice traders knew that the odds strongly favored the failure of any attempt to break above the trend line, it was a great location to put on shorts. Also, shorting when the bulls were at their strongest gave the bears a great entry. They saw the market as overextended and not likely to go much higher. Since they believed that the market might not go another tick higher, they finally came back into the market and shorted heavily and relentlessly, even though they were on the sidelines for several bars. The bulls used the test as a place to take profits on their scalps. Both the bulls and the bears knew that the market would be at the top of the channel only briefly, so both acted quickly. Bulls quickly scalped out of their longs because they did not want to risk the market reversing down quickly below their average entry price, and the bears began shorting heavily and continued to short all the way down to the test of the bottom of the channel. There, some took partial profits and others continued to hold short until they saw a strong trend reversal, which did not come until the next day. Deeper discussion of this chart. The market formed a wedge bear flag with bars 2, 4, and 6 in figure 15.6, and once the market broke below the flag, it fell to a measured move down, reaching the target 3 bars before the close. The day opened with a small gap down, but the first bar was a doji, and therefore a weak setup for a failed breakout long. By bar 3, the day was a trading range, so it was acceptable to short below the bar 3 low 2, especially since the high or low of the day usually forms in the first hour, and this was a possible high of the day. The market might have been forming a lower high and was failing to hold above the moving average. Bar 5 was a test of the break-even stops of the traders who shorted below bar 3 and set up another low too short at the moving average. The market was forming lower highs and lows and might have been in the early stages of a bear trend. When the market is in a channel, the reversal setups often don't look quite right. That is because they are not reversal setups, but just the beginning of flag pullbacks. In figure 15.7, the E-mini completed a wedge bull flag down to bar 12, which poked a couple of ticks below an earlier low on the 60-minute chart insert, and set up a large double bottom bull flag. Traders saw the market as flipping to always in long on the bar after bar 12, on bar 14, or on the breakout above the bar 18 signal bar for the bull breakout of a small triangle. Bars 15, 17, and 18 were the 3 pushes down. Bull trend is either in a spike or in a channel. Since the market was not in a strong spike, traders assumed that it was in a bull channel, which meant that there would be pullbacks. Anything that looked like a low 1 or low 2 signal bar was then a buy signal. Instead of shorting below those bars, there would likely be more buyers at and below the lows of the signal bars. This is what happened with the low 1 short signal bar that followed bar 17. Traders bought the breakout below the bear inside bar because they saw the market as always in long and in a bull channel, and not in a bear leg. They wanted to buy at and below the low of the bar before bar 18, expecting the low 2 sell signal to fail. However, the bulls were so eager to get long that they placed their buy limit orders 1 tick above the low of the bar. They were afraid that there would not be enough bears left to push the market below the low of the sell signal bar, and they did not want to get trapped out of what they saw as the early stage of a bull trend. They saw the market as always in long, and believed that the bears were wrong and that any sell signal would fail. They expected any sell-off, along with any opportunity to buy on a markdown in price, to be brief. They were happy to see any bear trend bar, especially a low 1 or low 2 that might trap bears, who would then be forced to buy back their losing shorts as the market reversed up. These bears would then be buyers, helping to lift the market, and they would be hesitant to short again for at least a few bars. This would make the market one-sided in favor of the buyers, giving them at least a scalper's profit and possibly a swing profit. Because the 3 pushes up to bar 16 were in a tight bull channel, many traders saw that wedge as a single spike up and were looking for a bull channel to follow after a pullback. Since the 3 prior pullbacks in the rally were between 5 and 9 ticks, bulls would have placed limit orders to buy pullbacks of about that size. The pullback to bar 20 was 7 ticks, the pullback to bar 22 was 8 ticks, and the pullback to bar 24 was also 8 ticks. Other traders just buy with limit orders at 1 to 3 ticks below the low of the prior bar in a channel, risking to below the most recent swing low. For example, they bought as bar 20 fell below the small doji before it, or below bar 19, and had their protective stops below bar 17. To a beginner, this is counterintuitive, but to experienced traders, this is an opportunity. They know that 80% of attempts to break below the bottom of the channel will fail, so buying as the market is making an attempt is likely to be a good trade. Bears who saw the entire move up from bar 12 as an overdone bear rally were unhappy with how weak the short signals were at bar 13, the bar before bar 15, bar 16, the bar after bar 19, the bar before bar 21, bar 23, and the bar after bar 25. Whenever the market is working higher in a relatively tight channel, All of the sell signals tend to look bad, because they are not really sell signals. They are just the start of small bull flags. Since the strong bulls are buying below the lows of the prior bars and on limit orders that are located between maybe 5 and 10 ticks below the most recent swing high, it is a low probability bet to short exactly where the strong bulls are buying. In a tight bull channel, it is rarely wise to short below the low of a bar unless there has been a strong climactic reversal after a breakout of the top of the channel. And even then, it is often better not to short below a bar until after a sell-off that is then followed by a lower high. Remember, the market is always in long, and it is always better to only buy until the market flips to always in short. It is easy to look at the channel and see it as weak, and to look at the sell-off down to bar 12 and assume that the bears will return, but you have to trade the market in front of you, not the one that just ended or the one that you think should soon begin. When a channel has relatively small bars, bars with prominent tails and trend bars in the opposite direction, there is significant two-sided trading taking place, even though the channel is a trend. This creates an opportunity for counter-trend scalpers. The channel up from bar 18 is an example. Bears will short the closes of bull trend bars above prior swing highs, like the bar after bar 22, and the closes of small bull bars that follow, like bar 23, for scalps. Many are willing to scale in higher. Scaling into trades is discussed in Book 2. For example, if they shorted the close of the bull trend bar after bar 20 and one or more of the closes of the small bull bars that followed, or a point or so above their first entry, they would then take profits on their entire position at their original entry. That original entry would then be a break-even trade, and their later entries would give them a scalper's profit. These profit-taking bear scalpers bought back their shorts on the low of bar 22, since its low fell below the entry price of their first entry, the close of the bull trend bar after bar 20. That bar was also a test of the moving average, so there were also bulls who bought the test, in addition to the profit-taking bear scalpers who exited because the market reached whatever profit target they were using, such as the close of the bull trend bar after bar 20. The moving average, a breakout test of the 16 high, or 5 ticks below the high of the doji bar after bar 20. As discussed in Book 2, that was a weak buy signal bar, so bears would have shorted with a limit order at its high, and they would have scalped out 1 point lower. This meant that the market had to fall 5 ticks, which it did at the bar 22 low. There are always many different traders entering or exiting at every tick all day long for every conceivable reason. The more reasons that line up in the same direction, the more likely the market will trend. In addition to entering on stops, entering on limit or market orders can be an effective approach whenever the market is in any type of channel, including triangles and trading ranges. In Figure 15.8, the market had 8 consecutive bull trend bars in the strong bull spike up to bar 3, so the market was likely to have a test of the high after a pullback. Although bears shorted below the bar 3 bear reversal bar, bulls were scaling in on limit orders below the low of the bar. Some bought on a limit order at the low of bar 3, but because the next bar was a strong bear trend bar, there were far more sell orders. Other bulls bought on a limit order at 1 tick above the moving average, since the market might have only touched the moving average and not filled a buy limit order exactly at the moving average. Some bulls scaled in lower, maybe buying more at 1 point intervals. If they did, they could have then put a limit order to exit both positions at the entry price of the first order at or just below the low of bar 3. They would have been filled on bar 5, would have broken even on the first entry, and would have made a profit on their second. This profit-taking by these bulls contributed to the bear reversal bar at bar 5. Traders saw the doji inside bar after the bear trend bar that followed bar 3, and many thought that this was not a good short setup. Since they believed that shorting below the bar would likely not yield a profitable scalp, some traders instead bought on a limit order at or 1 or more ticks below its low. This buying contributed to the tail at the bottom of bar 4. Bar 4 was the 4th consecutive down bar, which is enough bearish momentum to make traders hesitant to buy above its high, even though they believed the market would test the bar 3 high. They expected the first attempt up would likely fail, and they preferred to wait for a two-legged pullback to buy. Bears realized this and thought that the traders who bought above bar 4 would likely lose money. This made shorting on a limit order at or just above the high of bar 4, a reasonable scalp. They exited with a 1-point profit as bar 6 fell 5 ticks below the high of bar 4. Why was the low of bar 6 exactly 5 ticks below the high of bar 4? In large part because those short scalpers became buyers as they took their profits down there, and their buying helped create the tail at the bottom of bar 6. Since most traders still believed that the market should test the bar 3 high, they were still looking to buy. Since the market clearly became always in long in the spike from bar 1 to bar 3, and there was not yet a clear flip to short, the always-in position was still long. Therefore, they did not believe that shorting below the low of bar 5 was a good trade. Given that they thought it would be a losing trade, many traders did the opposite and bought on a limit order at or below the low of bar 5. Their buying, in addition to the buying by the shorts who were taking profits from their scalp down from above bar 4, created the tail at the bottom of bar 6. Bar 6 was a two-legged sideways correction down from the bar 3 high, and many traders bought above bar 6 on a stop for the test of the bar 3 high. At the same time, many of the traders who bought below bar 5 sold out for a profitable scalp on the rally. Although the market formed a double top at bar 7, many traders did not expect a trend reversal and instead expected a trading range and then a bull channel, because that is what usually happens after such a strong spike on a day where a strong case could be made that bar 1 was likely going to remain as the low of the day. Bar 7 formed a 2-bar reversal with the bar before it, and the better entry is below the lower of the 2 bars. The problem with entering below the low of the bar 7 bear bar is that the market often has a 1-tick bear trap. This means that it falls 1 tick below the bear bar, but not below the low of both bars of the 2-bar reversal, and then the rally resumes. This risk is less if you enter below the low of both bars, and that is why the market reversed up 6 ticks later. The bears bought back their shorts on a profit-taking limit order located 5 ticks below the signal bar low, which usually requires the market to fall 6 ticks. The bar 8 low was exactly 6 ticks below the bottom of the 2-bar reversal. If this was a strong bear trend, traders could short on a stop below the prior swing low at bar 4. Since most traders thought that the low of the day was in and that the market would likely form a bull channel, they thought that shorting below the bar 4 low was a bad idea. This means that buying below its low might be a good long, especially if the traders could scale in lower if need be. Also, since the market was likely to form a channel that could last for hours and the market might not again come down to this level, these bulls could swing some or all of their positions. Other bulls saw bar 8 as the second leg down from bar 3. Bar 4 was the first leg down, and they bought above the high of bar 8 on a stop. The bar after bar 8 was a doji bar, which indicates that the market is still two-sided. Bar 8 was not a strong bull reversal bar, and the 2-bar spike down from bar 7 made traders wonder if the market might be reversing. Traders had to decide if they thought that bar 9 was going to be the lower high pullback that would lead to a bear channel, or if always in was still long, and that the market was in the early stages of a bull channel. The traders who thought that the bottom was in believed that bar 9 was a bad short setup, and they placed limit orders to buy at and below the low of bar 9. Many of these bulls would have added on if the market fell below the bar 8 low. Bears who shorted below bar 9 bought back their shorts when the market reversed above the bar 10 entry bar. Bulls also bought, believing that this failed short was more evidence that a bull channel was forming. Channels have lots of pullbacks along the way, and the bulls would not let themselves be stopped out by a pullback. Instead, they would buy on a limit order at or below the low of the prior bar, like below bars 9 and 11. Since channels have two-sided trading, as long as the channel is not too tight and too steep, bears will short at or above swing highs. For example, they would have shorted as bar 12 went above the bar 7 high, and some would have added on 1 point higher. This, in part, was the reason that the high of bar 13 was exactly 5 ticks above bar 7. They would also have shorted on the move up to bar 17 as the market went above the bar 13 high. Some bears would even have shorted the sharp rally up to bar 30 as it moved above the bar 17 high, and they would have added on 1 point higher. They could have bought back both shorts at the original entry price as the market fell to bar 31. Their original short would have broken even and their add-on would have made a 1 point profit. The bulls would have looked at the rally up to bar 29 as having trending highs, lows, and closes, and therefore would have believed that it was strong. Some would have bought more on a stop at one tick above the bar 17 high. They could have exited with a profit on bar 30. Whenever a breakout trade results in a profit, it is a sign that the trend is strong. However, it is not absolute, and if the market is mostly in a trading range, as it was today, there may not be follow-through. There was two-sided trading throughout the day, and both bulls and bears were entering on limit orders and on stops. For example, once the always in position flipped to short at the bar 17 top wedge reversals are discussed later. Bears began shorting above the high of the prior bars, like above bars 18, 20, and the bar after bar 24. Bulls were buying below prior swing lows, like below bars 20 and bar 23. There were many other setups during this day, as there are on all days, but the purpose of this chart is not to show every possible trade. Instead, it is to make the point that when the market is in a bull channel, bulls are buying below the low of the prior bar and bears are selling above swing highs. In bear channels, they do the opposite. Bulls buy below swing lows and bears short above the high of the prior bar. Chapter 16. Microchannels. A micro trend line is a trend line on any time frame that is drawn across from 2 to about 10 bars where most of the bars touch or are close to the trend line, and the bars usually are relatively small. Typically, a trend channel line can be drawn along the opposite ends of the bars as well, and the result is a very tight channel called a microchannel. Unlike a conventional channel where pullbacks are common, a microchannel progresses with no pullbacks, or rare, small pullbacks, making it an extremely tight channel. The more bars, the stronger the bars, like bars with big trend bodies in the direction of the microchannel, and the smaller the tails, the stronger the microchannel, and the more likely that the first pullback will fail to reverse the trend. A microchannel can last for 10 or more bars, and other times it will run for about 10 bars, have a small pullback, and then resume for another 10 bars or so. It does not matter whether you view the entire channel as one big microchannel. A microchannel is a type of tight channel. Two consecutive microchannels separated by a small pullback, or a large tight channel, because you will trade it the same way. The trend is very strong, and traders will look at reversal attempts to fail and become pullbacks, and for the trend to continue. 10 years ago, traders saw microchannels as a sign of program trading. Now, since most trading is done by computers, it adds nothing to say that microchannels are signs of program trading, because every bar on the chart is due to program trading. A microchannel is just one particular type of program trade, and it is likely due to many firms running programs simultaneously. One or more firms will start it, but once the momentum is underway, momentum programs will detect it and begin trading in the same direction, adding to the strength of the trend. Once the trend begins breaking above resistance levels, breakout programs will start trading. Some will trade in the direction of the trend, and others will begin to scale in against the trend, or scale out of longs that they bought lower. Eventually, one of the bars penetrates through the trend line or the trend channel line, creating a breakout. Bull and bear microchannels can develop in bull or bear trends and in trading ranges. The environment in which they occur determines how to trade them. Both bull and bear channels can have breakouts to the upside or the downside. As with all breakouts, three things can then happen. It can be successful and be followed by more trading in that direction. It can fail and become a small climactic reversal. Or the market can just go sideways and the pattern can evolve into a trading range. As with any breakout, traders will trade either in the direction of the breakout, expecting follow-through, or in the opposite direction, if they expect the breakout to fail. Breakouts, failed breakouts, and breakout pullbacks are closely related and are discussed in Book 2. As a guide, traders compare the strength of the breakout with that of the reversal attempt. If one is clearly stronger, the market will likely go in that direction. If they are equally strong, the trader needs to wait for more bars before deciding where the market is likely to go next. When a bear microchannel forms in a bull trend, it is usually a bull flag, or the last leg of a bull flag, and traders will look for a signal bar and then place a buy stop above its high to enter on the breakout of the bear microchannel and of the bull flag. When a bull microchannel forms in a bear trend, it is usually a bear flag or the final leg of a bear flag, and traders will short below any signal bar. If instead of a bear microchannel forming in a bull flag, the microchannel is a rising microchannel, a bull microchannel, in a bull trend, the first downside breakout, the first pullback will usually not go far, and it will be bought aggressively. The more bars in the bull microchannel, the more likely that the bear breakout will not reverse the bull trend. For example, if there is a 5-bar bull microchannel in a bull trend, there will probably be far more buyers at and below the low of that 5th bar than sellers. If the market trades below that 5th bar, the bar creates a bear breakout of the bull channel. However, it is unlikely to lead to more than a bar or two of selling because the bulls will be eager to buy the first pullback from the strong microchannel bull trend. Remember, many traders have been watching the rally for 5 bars, waiting for any pullback to buy. They will be eager to buy below the 5th bar and above the high of the pullback bar, which is a failed breakout by signal bar, a high one by setup. If the market triggers the long but creates a bear reversal bar within a bar or two, this then sets up a micro double top sell signal. It can also be thought of as a pullback from the breakout below the bull micro channel, even if its high is above the highest bar in the micro channel. It would then be simply a higher high reversal, which is a micro version of a major trend reversal. Reversals are discussed in Book 3. It is important to realize that traders do not have to wait for a pullback to get long. Many experienced traders understand what is happening after the 2nd or 3rd bar of the bull micro channel in a bull trend. They think that the market is in the early stages of a very strong buy program where momentum buy programs are also buying aggressively. These traders will try to copy what the computers are doing and will buy every bull close and place limit orders 1 or 2 ticks below the close of every bar and 1 or 2 ticks above the low of the prior bar. If the biggest pullback in the micro channel has been 5 ticks, they will place limit orders to buy any 3 or 4 tick pullback. They expect that the first time a bar falls below the low of the prior bar will attract even more buying, so they know that their most recent buy will likely be profitable, despite the pullback. Since they made money all the way up, they are not worried about getting out at break-even or with a small loss on their final entry when a pullback finally does come. As with any channel, a bull micro channel can form in a trading range or within a bull or bear trend. When it is in a bull trend, higher prices are more certain, and traders should look to buy near the middle or bottom of the prior bar. When the micro channel is especially tight, it can be a spike on a higher time frame chart. A broader channel may follow, and it might reach a measured move target based on the height of the tight micro channel. When a bull micro channel is in a bear trend, it is a bear flag, and traders should look to short the downside breakout or the pullback from a downside breakout. When a bull micro channel forms after a possible low in a bear trend, it can become the final flag in the bear trend and break out to the upside instead of to the downside, and the breakout can be the spike that leads to a bull trend. When a bull breakout occurs, it usually follows a failed low 1, 2, or 3. A micro channel is a sloping, tight trading range, and therefore it has a strong magnetic pull that tends to prevent breakouts from going very far. It is also often tight enough to sometimes act as a spike, and it can be followed by a broader channel, creating a spike and channel trend. When there is a breakout from a micro channel, it is usually just for a bar or two and is mostly due to profit taking. For example, if there is a bull micro channel, an upwardly sloping micro channel, and a bar trades below the low of the prior bar, that is a breakout below the micro channel. This is primarily due to bulls taking profits, although there are some bears who are shorting. Within a bar or two, other buyers come in, some bears exit, and the market usually trades above the high of the prior bar. Some traders will see this as a failed breakout of the micro channel, and they will buy as the market goes above the high of the prior bar. For them, this is a high one buy setup. Others will assume that the trend is reversing down. They will wait for the market to form either a higher high or lower high breakout pullback over the next couple of bars, and then they will short below the low of the prior bar. The overall context can give a clue to which outcome is more likely. For example, if the market is in a strong bear trend and the bull micro channel is just a pullback, the odds favor that the breakout below the micro channel will be followed by more selling. If the market trades above the breakout bar, bears will place stop orders to short below the low of the prior bar. If instead the bull microchannel is forming as a breakout from a trading range in a bull market, the odds favor the breakout below the microchannel becoming a pullback in the bull trend, and bulls will place buy orders at one tick above the high of the prior bar. A breakout of the trend line sets up a with-trend entry. For example, if there is a bull microchannel and the market is always in long, and then there is a bar with a low below the micro-bull trend line, then buying the high of that bar can be a reliable trade. This is a tiny but strong one-bar bull flag, a high one-buy setup, and it is a failed breakout buy signal. It might be a two-legged correction on a smaller time frame chart. However, it is better to not look, because you will find yourself with too much information to process in a short time, and you will likely mismanage or not take the trade. If the bull microchannel is within a trading range or in a bear trend, instead of in a strong bull trend, you have other things to consider before buying above the failed bear breakout. If the channel is at the top of a trading range, it is often better not to buy the failed breakout, and instead to wait to see if the reversal backup stalls and becomes a higher high pullback from the breakout. If it only goes up for a bar or two and then forms a bear reversal bar, this can be a reliable short setup when it is near the top of a trading range, a micro double top, discussed in Book 3. If the bull microchannel is a bear flag just below the moving average, you should only look to short, since the odds are that the shorting by the bears will overpower the bulls who bought the pullback. Wait for the breakout below the channel, and then for the failure and one more push-up. If that reversal backup forms a bear reversal bar at the moving average within a bar or two, this is usually a reliable breakout pullback short setup, a low 2. The market broke out of the downside of the bull microchannel and then pulled back to a small higher high. Finally, if it reversed back down, it set up a breakout below what has become a bear flag. As with any breakout below a bull channel, there might be a pullback and then a resumption of the selling. That pullback can be a lower high or a higher high. A higher high means that the high of the bar goes above the high of the most recent swing high, which is likely the highest bar in the bull channel. Because most attempts at reversing a trend fail, the odds are in favor of the bear breakout failing and becoming just a pullback in the bull trend, followed by the bull trend resuming. Traders should place an order to go long at one tick above the high of the breakout bar, in case the bear breakout fails and the bull trend resumes. However, they must be aware that their long might be a bull trap, trapping them into a losing long trade. Remember, although most attempts to reverse a trend fail, some succeed. Instead of the breakout to the downside failing, the market might be just briefly pulling back from the bear breakout and forming a small higher high or lower high before the selling resumes. This could be followed by a successful trend reversal into a bear leg or trend. Because of this, the trader has to be prepared to reverse to short below his long entry bar if the overall price action makes a reversal seem appropriate. In this case, this is a breakout pullback short setup. Whenever a breakout fails, this failure sets up a trade in the direction of the original trend. If that also fails, then it becomes a breakout pullback from the original bear breakout. Opposite failures create a breakout pullback, and a second attempt to reverse the trend to down. If the breakout pullback short triggers by the bar going one tick below the low of the prior bar, which is usually the bull breakout bar, look at the size of the bodies of the recent few bars. If the bars are bull or bear trend bars, then the second failure has high odds of being a successful second entry short. Remember, the first failure was when the bears lost on the failed downside breakout, trapping them out of their short trade. The second failure was when the bulls were trapped into their losing trade, which was set up by the failed bear breakout below the channel. If the market now turns down again, you have just had bears trapped out and bulls trapped in. In general, if both sides get trapped in or out, the odds of success of the next setup increase. If the bars have more of a doji look, then the market will likely enter a trading range, but the odds still favor a downside breakout. If you are not certain, then wait, because it is likely that most traders will not be certain and a trading range will usually follow. Although the vast majority of micro-trend line breakouts are 1- and 2-legged pullbacks on the 1-minute chart, you should avoid trading off that chart because you will likely lose money. Most traders are unable to take all of the signals and invariably pick too many losers and not enough winners. The best trades often set up fast and trigger quickly and are therefore easy to miss. Many losing trades are often slow to set up and give traders plenty of time to enter, trapping them in the wrong direction. That bull micro channel could instead have a breakout to the upside, above the trend channel line, in an attempt to form an even steeper bull trend. If it fails and there is a strong bear reversal bar, this buy climax is a potential short setup. When a micro trend line extends for about 10 or more bars, the odds increase substantially that there will soon be a tradable reversal. This type of trend is unsustainable and therefore a type of climax, which is usually followed eventually by a pullback or a reversal. After such climactic behavior, be ready to take a breakout pullback entry. This is the second attempt to reverse the trend, with the original trend line breakout being the first. A micro trend line break is important not only when the micro trend line is part of a micro channel, but also whenever there is any strong trend underway. If there is a strong bear trend with large bear trend bars and little overlap between consecutive bars, and there are no pullback bars for 4 or 5 bars, you are likely eager to get short. Look for any bear micro trend line, and then sell below the low of any bar that pokes above any bear micro trend line. Any poke through it is a setup for a failed breakout short entry. Enter at 1 tick below the bar that breaks above the bear micro trend line, a low 1 short setup. Small, steep trend lines, even drawn using 2 consecutive bars, often provide setups for with trend trades. If the trend is steep, sometimes a small pullback bar or a pause bar can penetrate a tiny micro trend line. When it does, it can become a signal bar for a with trend entry. Some of the penetrations are smaller than 1 tick in the E-minis, but are still valid. When there is a trend, and then it has a pullback, it is common to see a micro trend line in the pullback. For example, in a pullback in a bull trend, if there is a bear micro trend lasting about 3 to 10 bars, and then there is a break above that bear micro trend line, this theoretically sets up a short on the failed breakout. Since this is occurring during a bull trend, and it almost always happens above or near the moving average, you should not be shorting this pattern. You would find yourself holding a short at the bottom of a bull flag near a rising moving average in a bull trend, which is a very low probability trade. As this short will likely fail, you should anticipate this and be ready to buy the failure, getting in exactly where the trapped shorts will get out. Your long will be a breakout pullback buy since the market broke above the bear micro trend line and then pulled back to either a small lower low or a higher low. And then the market resumed in the direction of the breakout, which is also the direction of the major trend of the day. It is critical to remember that micro trend lines should only be used to find with trend setups. However, once the trend has reversed, for example after a bull trend line break and then a reversal down from a higher high, you should be looking for micro trend line short setups, even if they are at or just above the moving average. As with any chart pattern, a micro channel's appearance is different on both smaller and higher time frame charts. Even though the trend bars in a micro channel or any other type of tight channel are usually not large, and there is usually a lot of overlap between adjacent bars, the trend is strong enough to be a large trend bar or a series of trend bars on a higher time frame chart. This means that it often functions as a spike and is often followed by a broader channel, like any other spike and channel trend. Also, even though there are no pullbacks in the micro channel, there are many pullbacks if you look at a small enough time frame chart. Small trend lines can generate many scalps during the day, especially on the 1-minute chart, which is seldom worth trading. In Figure 16.1, the chart on the left is a 1-minute E-mini chart, and the numbers correspond to the same bars on the 5-minute chart on the right. Both show that failed breakouts from tiny trend lines can result in profitable fades. There are other trades on the 1-minute chart that are not shown because the purpose of this figure is only to show how 5-minute micro trend lines correspond to more obvious, longer trend lines on the 1-minute chart. So if you can read the 5-minute chart, you do not have to additionally look at the 1-minute chart to place your orders. Many of these trades could have been profitable scalps on the 1-minute chart. Note that several breaks of micro trend lines on the 5-minute chart are easy to overlook and are less than 1 tick in size. For example, Bars 3, 5, 6, and 7 were failed micro-trend line breaks on the 5-minute chart that would have been invisible to most traders, but the one at bar 5 was particularly significant and led to a good short scalp. It was the second failed attempt to break above a bear trend line. Bar 3 was the first. The failed breakout below the bull micro-channel at bar 7 was a risky long and a scalp at best. Since it was a bear flag pullback to the moving average, it was better to expect the move up to stall and become a breakout pullback sell setup, which it became here. Price action trading works even at the tiniest level. Note how bar 8 on the 1-minute chart was a higher high breakout test. It tested the high of the bar that formed the low of the bear trend, long setup, and that although the market came down to test the bar 8 signal bar low 2 bars after entry, the protective stop below the signal bar would not have been hit. Also note that there was also an even smaller major reversal in this segment of the 1-minute chart. There was a tiny bull trend, indicated by the bull micro-trend line up from the low of the chart, then a break of the trend line at bar 7, and then a higher high test of the tiny bull trend extreme. Since the pattern is so small, the trend reversal down to bar 8 was just a scalp as expected. On the 5-minute chart, bar 8 did not set up a long. Why? Because it was a pullback in a bear trend. You should not be buying the top of a pullback in a bear trend day. Instead, once you see the micro-trend line by trigger, get ready to short its failure, entering exactly where the trapped longs will be forced out with their losses. Even trend lines created using just 2 or 3 consecutive bars in a steep trend can set up with trend entries when there is a small break that immediately reverses. Each new break becomes the second point in a longer, flatter trend line, until eventually trend lines in the opposite direction become more important, and at that point, the trend has reversed. In Figure 16.2, bar 1 dipped below a 3-bar trend line and reversed up, creating a long entry at 1 tick above the prior bar. Bar 2 dipped below a 6-bar trend line. Traders would have placed buy stops above its high. When not filled, they would move their buy stops to the high of the next bar and would have been filled on bar 3. This was a high one by entry, and most bear breakouts of bull micro-channels in a bull trend fail and become high one by setups. Since the micro-channel is usually breaking above something, like a prior high, as it did here when it moved above the first bar of the day, the high one is usually also a breakout pullback by setup. Incidentally, the bar before bar 2 was a possible short setup based on a failed breakout of a micro-trend channel line, not shown, that is a parallel of the 3-bar micro-trend line leading up to bar 1. The upward momentum was too strong for a short without a second entry, but this illustrates how micro-trend channel lines can set up countertrend trades. Bar 4 was a small inside bar that extended below a 2-bar trend line. The penetration is not shown. The buy is on a stop at 1 tick above the high of the small inside bar. Bar 5 broke the major trend line of the day. Any trend line lasting about an hour or so is more significant, so traders would be thinking that a 2-legged pullback was more likely. After the break above the bear trend line on the bar following bar 5, a short would be triggered on the bar 6 lower high. When bars are small doji bars like those following bar 5, it is usually best to wait for bigger trend bars before taking more trades, but these trend line reversals still led to profitable scalps of 30 to 50 cents in Amazon. Since bar 5 was the first breakout of a fairly tight bull channel, it is better not to short it, and instead to wait for a breakout pullback to short. Bar 6 was a reasonable lower high breakout pullback short entry for a scalp down toward the moving average. This was not a good trend reversal trade because there had yet to be a test of the moving average followed by a test of the bull trend high. Bar 6 was a micro trend line short in a bull trend, which is a bad trade when it occurs close to the moving average. Here, however, there was plenty of room down to the moving average. In addition, it was following a wedge top and therefore would likely be part of a 2-legged correction down. Unlike a conventional channel, where pullbacks are common, in a micro channel the lack of pullbacks is one of its defining characteristics. For example, in the bull micro channel that started on the bar before bar 8, the first leg ended with the small bar 9 pullback. Some traders saw the next 4 bars as part of the same channel, with bar 9 as a pullback, and other traders saw bar 9 as the start of a second micro-channel. It really does not matter, because the sideways move to bar 10 broke below both. Deeper discussion of this chart. The market gapped up in figure 16.2 and therefore broke out above the close of yesterday, and the first bar was a bull trend bar. The body was reasonably strong and there was a tail below, both showing buying pressure. Yesterday closed with some bull bodies, again showing strength by the bulls. So this bar was not a strong signal bar for a short on the basis of a possible failed breakout setup. The second bar had a bear body and dipped below the low of the first bar and was a reasonable breakout pullback long setup for a possible trend from the open bull day. There were 4 bull trend bars, creating a spike up, but the final one had a large range and might indicate some exhaustion. This led to the first pullback long setup, and bar 3 was a strong entry bar. This was also a breakout pullback long from the breakout above the opening high. Since the first bar of the day was unusually large, it could and did lead to about a measured move up. Small trend lines and strong trends, even when drawn using adjacent bars, often have failed breakouts that set up good with trend entries. Many of these are 2-legged pullback setups, ABC corrections on 1-minute charts. But you don't need to look at the 1-minute chart when you see the false breakouts on the 5-minute chart. When trading, you do not have to actually draw the trend lines on the chart very often because most trends are visible without the help of the drawn lines. There were many good with trend entries in Opal on this 5-minute chart in figure 16.3 based on failed breakouts of micro trend lines. When the trend is steep, you should only be looking to trade with the trend and you should not be trading small reversals. For example, even though bar 3 broke above a bear micro trend line, the bear trend was actually a bull flag in a strong bull trend where the market has been above the moving average for more than 20 bars. You should only be looking to buy and not short, especially not just above the moving average. Bar 2 was a breakout below a bull micro channel in a strong bull trend, and it should be expected to fail. This set up a reliable high 1-buy setup. Bars 10 and 12 were first breakouts above steep, tight channels, and therefore not good long entries. Although bar 12 was the second breakout to the upside on the way down, the move down from bar 10 lasted several bars and was steep. It therefore created a new small micro channel, and bar 12 was the first attempt to break out of the new channel. Both bars 10 and 12 were low 1-sell signal bars. Bar 9 was a bear reversal bar and a signal bar for the downside breakout of the small triangle. A triangle is a mostly sideways trading range with 3 or more pushes in one or both directions. The bar before bar 9 was the third of 3 small pushes down, and was the point at which the trading range became a triangle. Since the market was in such a tight bear channel from the first bar of the day, it was unreasonable to believe that the triangle would be a reliable buy setup. In fact, most traders did not see the pattern as a triangle yet, and were continuing to look for shorts. Once the bar 9 bear reversal bar formed the third push-up, traders were confident that the pattern was a triangle in a bear trend and a reliable sell setup. Even though bar 9 had a bull body, it was a small doji and therefore did not have much buying pressure. However, it was still a reversal bar since it closed below its midpoint. Bar 9 would have been a stronger signal if it had bear body. The tight bear channel that ended 3 bars after bar 8 had several smaller micro-channels within it. It does not matter whether a trader sees the tight channel as a large micro-channel with a couple of small pullbacks, 3 consecutive micro-channels, or as a large tight bear channel, because he would trade the market the same way. The move down is very strong and is probably a strong spike on a higher time frame chart. Smart traders were looking for any pullback to short, expecting that any pullback would simply be profit-taking by the bears, and would be followed by lower prices and not a trend reversal. In a strong trend such as this, traders will short above the high of the prior bar and below the low of any pullback, like below bars 9, 10, and 12. Many bull trends that have only small pullbacks but result in large profits have low probability short setups. For example, both bars 10 and 12 were doji bars in areas of other bars with tails, and therefore were signs of two-sided trading. When the market begins to develop signs of two-sided trading, it often is evolving into a trading range, which means shorting near its low and hoping for a breakout of the developing trading range, is a low probability short. The probability of a successful swing down might be only 40%. However, since the reward is several times the risk, the trader's equation is still very positive. Traders who prefer to take only high probability trades would not have shorted below bars 10 or 12, and instead would have waited for high probability reversals to buy, like the bull reversal bar after a series of sell climaxes at the low of the day. Reversals are discussed in Book 3, or pullbacks to short like the bar 9 triangle, or strong bear spikes to short like the bar 11 close, since it was a breakout below a wedge bottom. The low of the bar before bar 11 and the high of bar 12 formed a measuring gap, which is discussed in Book 2. Deeper discussion of this chart. In Figure 16.3, yesterday closed with a strong bull trend bar breakout of a largely horizontal bull flag after a protracted bull trend. This was a final flag short setup, and it triggered on the first bar of today. Traders could short below the bull trend bar or below the first bar, which had a small bear body, or below the bottom of the final flag. The entry bar was a large bear spike and was followed by a tight and therefore very strong bear channel. The day was a trend from the open bear trend day. The first reversal attempt of micro channels is due to profit taking. For example, when the bear bar before bar 2 broke below the bull micro channel, it was due mostly to bulls taking profits. Other bulls were eager to get long, since this was in a bull trend, and bought using limit orders as that bear trend bar fell below the low of the prior bar, and others bought one to several ticks below. Some bought on the close of the bear bar, expecting it to become a failed breakout. Limit order entries are discussed in Book 2. Traders who prefer stop entries bought above the bar 2 bar reversal, which was a high 1 and a breakout pullback by setup. What appear as micro trend line setups on a 5-minute chart are usually 3 to 10 bar pullbacks on the 1-minute chart. See Figure 16.4. The 1-minute E-mini provided entries on trend line tests and trend channel overshoots and reversals all day long. Many of the penetrations were less than 1 tick, but still meaningful. The lines shown are just some of the ones that could be drawn on this chart. There are many others. Just because it looks easy when you look back at a 1-minute chart at the end of the day does not mean that it is easy to make money trading the chart in real time. It is not. Invariably, the best setups look bad but set up and trigger too fast to take them, whereas the losers give you plenty of time to get in. The result is that you end up taking too many bad trades and not enough good ones to offset your losses, and you lose money on the day. Each successive trend line in Figure 16.4 gets shallower until trend lines in the other direction dominate the price action. A microchannel is usually a trend bar, a spike, on some higher time frame chart, and a channel with many pullbacks on a smaller time frame chart. There were many micro-trend line and channel trades in the E-minis on the day, charted in Figure 16.5. Only 4 are shown. A very unusual day when the Dow was down over 700 points but rallied into the close to make back half of the loss. Bar 5 was a micro-trend channel overshoot that became the first bar of a 2-bar reversal. The channel line was a parallel of the bars 1 to 4 micro-trend line. You could also have drawn the channel line using the low of the bar after bar 1 and the low of bar 3. There was a great Roman 2 setup where both bars had bull closes, which is always desirable when fading a strong bear trend. The bar after bar 5 formed a 2-bar reversal with bar 5. When a microchannel starts having 5 to 10 bars like the channel from the open that ended at bar 5, you can just as accurately simply refer to it as a channel. The term does not matter because a microchannel is simply a channel, and the only reason to distinguish it from larger channels is because microchannels often set up reliable with trend scalps and trends. Bars 7 and 9 were micro-trend line failed breakout short scalps, and both were quickly followed by buy scalps as the failures failed, creating breakout pullback buy setups, even though both were lower lows. Bar 7 was the first breakout above the micro-channel and therefore not a good long setup. Instead, it became an outside-down entry for a short. You could also have waited for bar 7 to close to be sure that it had a bear body, and then short the breakout below the bar 7 outside-down bar for a scalp. Bar 11 was a classic trap to get you out of a strong rally. If you exited, you needed to buy again on the high one above the bar 11 micro trend line false breakout. Bar 9 was a breakout above the bear micro channel, and bar 10 was a lower low breakout pullback, so traders were wondering if a larger rally was likely. Bar 10 had a small bear body, and the next bar was a strong bull trend bar. The following bar also had a bull body. The buying pressure was building, and that made that third bull bar a weak low one sell setup. Traders expected it to fail and bought at and below its low. They did not know that a bull trend would follow, but believed that the market would rally enough for at least a long scalp. Within a bar or two after bar 11, traders saw the market as always in long and swung the remainder of their longs and even added to them. Many of the bars today had a range of over 6 to 8 points. It would be prudent to reduce your position size to half or less and increase your stop to 4 points and your profit target to 2 points. Otherwise, it was just another well-behaved price action day. Deeper discussion of this chart. The day opened with a large gap down in figure 16.5, but the first bar was a strong bull reversal bar and therefore set up a trend from the open buy signal based on the failed breakout below the close of yesterday. The third bar was a strong bear bar and therefore a spike down, but the market might just be forming a higher low before the rally resumes. Instead, the market traded above the higher low and then reversed down in an outside bar down bar 1, triggering a breakout pullback short entry. The gap down was the breakout, and the failed breakout and attempt to rally failed and became a breakout pullback for a resumption of the bear breakout. Traders reversed to short as the bar went outside down. Other traders shorted below the low of the outside down bar, and others shorted below the low of the bull reversal bar, the first bar of the day. The day became a large trend from the open bear day as the market traded in a tight channel down to bar 5. The channel was so tight that it was effectively just a spike. The market pulled back to the moving average, and then a bear channel unfolded down to the bar 10 low of the day. Most failed micro-trend line trades are low 1 entries in bear trends and high 1 entries in bull trends. Bar 9 was a low 1 sell setup. Bar 11 was a high 1 buy setup. It was the first higher low in the new bull leg, and a higher low after a possible trend reversal into a bull is a good buy setup. The low 1 signal bar before bar 11 was a doji bar, and it followed 2 bull trend bars. The first was a strong bull trend bar that might have turned the always in direction to long. It was a 2-bar reversal with the bar after bar 9, after the bar 9 1-bar final flag. Aggressive bulls would have bought with limit orders at the low of the low 1 signal bar, expecting the short to fail. Breakout pullback trades that have higher highs or lower lows are small final flag reversals. For example, bar 9 was a breakout above a micro trend line, and the breakout failed and sold off to a lower low at bar 10. Bar 10 can be thought of as a pullback from the bar 9 breakout, and it pulled back to a lower low, which breakout pullbacks sometimes do. Since it reversed up, bar 9 became a 1-bar long final flag. The sell-off down to bar 5 was in a tight channel, but it was so strong that it had to be a spike down on a higher time frame chart. The market then rallied to the moving average, where there was a 20-gap bar sell signal. This was followed by a long channel down to bar 10, completing the bear spike and channel pattern. The first target of the reversal was the top of the first strong buy setup, which was the bar 5 2-bar reversal. After that, the next target was the start of the bear channel, which was the moving average test at 830. On a strong bull trend day, shorts should be avoided, including micro-trend line shorts, especially near or above the moving average. In figure 16.6, shorting on bars 1, 2, and 3 would have been selling against the bull trend in the area of the moving average or above the moving average. Yes, the downward sloping micro-trend line indicated that there was a small bear trend, but each occurred as part of a pullback in a very strong bull trend, and you should have been only looking to buy. These were bull flags, and they were above the moving average, which is a sign of bull strength. There had been no break of a significant bull trend line, followed by a reversal down from a higher high or lower high test of the bull high. The only value of bear micro-trend lines on a bull trend day is to alert you to buy the breakout pullback, that will form as the micro trend line short fails. In other words, don't short on bars 1, 2, and 3, and instead go long where those shorts would have covered. The failure would form a small lower low like after the bars 2 and 3 failed micro trend line breakouts, or a small higher low like on the bar 1 failed breakout, and would just become a pullback in the bull breakout of the bear micro trend line, a breakout pullback long setup. With trend micro trend line entries are high probability trades, like the longs at bars 4 and 5. Deeper discussion of this chart. The chart in figure 16.6 shows a trend from the open bull day, so shorts should be avoided, including micro trend line shorts, especially near or above the moving average. The market broke out below the moving average but immediately reversed up in a failed breakout. The bears tried to turn the rally into a breakout pullback short at the moving average, but the rally had several strong bull bodies, which meant that traders should short only on a second entry. There was none. The sell-off was brief and became a higher low. Chapter 17. Horizontal lines, swing points, and other key price levels. Most days are trading range days or have a lot of trading range activity. On these days, you will find that horizontal lines across swing highs and lows often serve as barriers that result in failed breakouts and then reversals. Expect swing high breakouts to fail and form higher high reversal setups, and swing low breakouts to fail and form lower low reversal setups. Sometimes the failure fails, which is a breakout pullback setup, and the market makes a second more extreme higher high or lower low. A fade of a second higher high or lower low setup is even more likely to be successful, because they are second attempts to reverse the market, and second signals are good setups on trading range days. On trend days, horizontal lines should generally be used only to enter on pullbacks. For example, if there is a strong upside breakout of a trading range on a bull trend day, there might be a pullback to the area of breakout level after a few bars. If there is a bull reversal setup on the test, this is a good breakout pullback buy setup. Most days are not strong trend days, and on these days traders should be looking at all prior swing highs and lows to see if the market creates failed breakouts, which can lead to reversal entries. Second signals are the best. A second higher high or lower low is a more extreme point on a trading range day where the middle of the day acts like a magnet, and this further extreme is therefore more likely to yield a scalper's profit. For example, in figure 17.1, bar 5 was a second higher high over bar 2. Bar 9 was a second attempt to reverse up after falling below the low of the open, and a double bottom with the low of the day before. Deeper discussion of this chart. Bar 5 was also the third push-up from the bar 3 low in figure 17.1. Even though it did not have a wedge shape, 3 push patterns usually behave like wedges and can be considered to be variations of wedges. Bar 9 was the 7th point of an expanding triangle bottom. Even though it was a double bottom with yesterday's low and not a lower low, close is close enough, and bar 11 was an expanding triangle top. It was also a smaller expanding triangle where bar 10 was the second push-up, and it was about 5 bars after the first. Bar 13 was a large double bottom pullback. There were multiple bottoms to choose from for labeling the double bottom, and bars 3 and 9 might have been the best. It was also a high 2 buy setup since it was at the bottom of 2 large, complex legs down. Since bars 9 to 11 formed a bull channel, which is a bear flag, bar 13 was a failed breakout of that bear flag. It was also a large wedge bull flag where the small swing low before or after bar 10 was the first push down, and bar 12 was the second. Bar 15 was a double top bear flag. It failed as a large bull breakout bar went above its high, and the market became noticeably more bullish. Bar 17 was a second lower low below bar 14 and a lower low below bar 16. It was also a wedge bull flag with bars 14 and 16, and a breakout pullback to a higher low following the breakout above the bull flag of bars 11 to 13. On strong trend days, consider fading swing highs in bull trends and swing lows in bear trends only if there was first a good trend line break and a strong reversal bar. In figure 17.2, both days were strong trend days with one extreme near the open, and then no moving average pullback for over 2 hours, 20 gap bar pullback setups. Bar 4 was a bear reversal bar and a reversal down from the breakout above a trading range following a small reversal up from a breakout below. Also, Bar 8 was the first bar of a small 2-bar reversal, and there was a higher low above Bar 7. However, since these are countertrend, and there was only minimal countertrend momentum on the trend line breaks, these trades are not strong and should only be scalps. Do not take them if they are distracting you from the with trend entries, where you should swing much of your position. Deeper discussion of this chart. In Figure 17.2, today opened with a breakout below the bull channel of the final hour of yesterday. A bull channel should always be thought of as a bear flag. The first bar had a bear body, indicating strength by the bears on the open, but the next bar reversed up in an attempt to form a failed breakout and a trend from the open bull day. Instead, the failed breakout failed and led to a breakout pullback short below the fourth bar and again below the low of the opening range. There was a strong 2-bar bear spike followed by a protracted bear channel. Bars 1 and 5 formed a double bottom bull flag, and bar 9 was part of a double top bear flag. Bar 8 was another small double bottom bull flag. Remember, a double bottom bull flag is often just a higher low that is a double bottom. Bar 4 was a possible top of a channel in a spike and channel bull day, and the market tested down to the bar 1 beginning of the channel. This set up a double bottom bull flag by setup. Both bars 5 and 13 were moving average gap bar setups. They were after 11:30 a.m., when there is often a strong countertrend move that traps traders out of the trend and into the wrong direction. This sets up a reliable with trend trade that usually results in a new extreme and often lasts into the close. Chapter 18. Example of how to trade a trend. When the market is in a trend, traders should look for any reason to enter. The simple existence of a trend is reason enough to enter at least a small position at the market. Here are some other reasonable approaches that use stop entry orders, buying a high 2 pullback to the moving average in a bull trend. Selling a low 2 pullback to the moving average in a bear trend. Buying a wedge bull flag pullback in a bull trend. Selling a wedge bear flag pullback in a bear trend. Buying a breakout pullback after a breakout from a bull flag in a bull trend. Selling a breakout pullback after a breakout from a bear flag in a bear trend. Buying a high 1 pullback in a strong bull spike in a bull trend, but not after a buy climax. Selling a low 1 pullback in a strong bear spike in a bear trend, but not after a sell climax. When a bull trend is very strong, buying on a stop above a prior swing high. When a bear trend is very strong, selling on a stop below a prior swing low. Entering using a limit order requires more experience reading charts because the trader is entering in a market that is going in the opposite direction to the trade. However, experienced traders can reliably use limit or market orders with these potential setups. Buying a bull spike in a strong bull breakout at the market, at the close of every bull trend bar in the spike, or on a limit order at or below the low of the prior bar. Entering in spikes requires a wider stop, and the spike happens quickly, so this combination is difficult for many traders. Selling a bear spike in a strong bear breakout at the market, at the close of every bear trend bar in the spike, or on a limit order at or above the high of the prior bar entering in spikes is difficult for many traders. Buying the close of the first bear bar in a bull spike. Selling the close of the first bull bar in a bear spike. In a bull trend, buying at a bull trend line or at a prior swing low, a potential double bottom bull flag. In a bear trend, selling at a bear trend line or at a prior swing high, a potential double top bear flag. Buying at or below a low 1 or 2 week signal bar on a limit order in a possible new bull trend after a strong reversal up or at the bottom of a trading range. Shorting at or above a high 1 or 2 week signal bar on a limit order in a possible new bear trend after a strong reversal down or at the top of a trading range. Buying at or below the prior bar on a limit order in a quiet bull flag at the moving average. Shorting at or above the prior bar on a limit order in a quiet bear flag at the moving average. Buying below a bull bar that breaks above a bull flag, anticipating a breakout pullback. Selling above a bear bar that breaks below a bear flag, anticipating a breakout pullback. When trying for a swing in a bull trend, buy or buy more on a breakout test, which is an attempt to run break-even stops from an earlier long entry. When trying for a swing in a bear trend, sell or sell more on a breakout test, which is an attempt to hit break-even stops from an earlier short entry. Buying at a fixed number of ticks down from the high in a bull trend. For example, buying a 2, 3, or 4-point pullback in a bull trend in the E-mini when the average daily range has been about 12 points. Also, if the biggest pullback in the first couple of hours was 10 ticks, buying about an 8 to 12 tick pullback. Selling at a fixed number ticks up from the low in a bear trend. For example, selling a 50-cent bear rally in GS when the average daily range has been about $2.00. If the largest pullback in the first couple of hours was 60 cents, selling about a 50 to 70-cent pullback. Scaling into the direction of the trend as the market moves against you. If you scale in, plan out in advance what size each order has to be to keep your total risk the same as with a typical trade. It is easy to find yourself with too large a position and a protective stop that is too far away, so be very careful. In a bull trend that has not pulled back to the moving average in 20 or more bars, buy at the moving average on a limit order and scale in lower. For example, if there is a strong bull trend in the E-mini where the market has been above the moving average for 20 or more bars, buy with a limit order at 1 tick above the moving average. Buy more 1, 2, and maybe 3 points lower. If scaling in, consider exiting the entire position at the first entry price, but if the bull trend is strong, look to exit on a test of the high. In a bear trend that has not pulled back to the moving average in 20 or more bars, sell at the moving average on a limit order and scale in higher. For example, if there is a strong bear trend in the E-mini where the market has been below the moving average for 20 or more bars, sell with a limit order at 1 tick below the moving average. Sell more 1, 2, and maybe 3 points higher. If scaling in, consider exiting the entire position at the first entry price, but if the bear trend is strong, look to exit on a test of the low. In a strong bull trend, buy on the close of the first bear trend bar that has a close below the moving average. In a strong bear trend, sell on the close of the first bull trend bar that has a close above the moving average. In a strong bull trend, a pullback is a small bear trend. The bulls will expect that a breakout below a prior swing low in this small bear trend will fail, and they will buy there with a limit order. In a strong bear trend, a pullback is a small bull trend. The bears will expect that a breakout above a prior swing high in this small bull trend will fail, and they will short there with a limit order. A trader can always be long, short, or flat. At any moment during a trend, only 2 of those choices are compatible with being a successful trader. If the market is in a bull trend, successful traders are only long or flat. If it is in a bear trend, they are either short or flat. A tiny fraction of traders have the ability to consistently make money by trading against a trend, and you should assume that you are not part of that group. Unfortunately, most traders starting out go for years believing that they are, and they consistently lose money month after month and wonder why. You now know the answer. Every type of market does something to make trading difficult. The market is filled with very smart people who are trying as hard to take money from your account as you are trying to take money from theirs, so nothing is ever easy. This includes making profits in a strong trend. When the market is trending strongly with large trend bars, the risk is great because the stop often belongs beyond the start of the spike. Also, the spike grows quickly, and many traders are so shocked by the size and speed of the breakout that they are unable to quickly reduce their position size and increase their stop size, and instead watch the trend move rapidly as they hope for a pullback. Once the trend enters its channel phase, it always looks like it is reversing. For example, in a bull trend, there will be many reversal attempts, but almost all quickly evolve into bull flags. Most bull channels will have weak buy signal bars, and the signals will force bulls to buy at the top of the weak channel. This is a low probability long trade, even though the market is continuing up. Swing traders who are comfortable taking low probability buy setups near the top of weak bull channels love this kind of price action because they can make many times what they are risking, and this more than makes up for the relatively low probability of success. However, it is difficult for most traders to buy low probability setups near the top of a weak bull channel. Traders who only want to take high probability trades often sit back and watch the trend grind higher for many bars, because there may not be a high probability entry for 20 or more bars. The result is that they see the market going up and want to be long, but miss the entire trend. They only want a high probability trade, like a high 2 pullback to the moving average. If they do not get an acceptable pullback, they will continue to wait and miss the trend. This is acceptable because traders should always stay in their comfort zone. If they are only comfortable taking high probability stop entries, then they are correct in waiting. The channel will not last forever, and they will soon find acceptable setups. Experienced traders buy on limit orders around and below the lows of prior bars, and they will sometimes take some short scalps during the bull channel. Both can be high probability trades, including the shorts, if there is a strong bear reversal bar at a resistance level and some reason to think that a pullback is imminent. With so many great ways to make money, why do most traders lose? It is because there are even more ways to make mistakes. One of the most common is that a trader begins with one plan and, once in the trade, manages it based on a different plan. For example, if a trader just lost on his past 2 long swing trades and now buys a third, he might be so afraid of losing again that he scalps out, only to watch the trade turn into a huge trend. Swing traders need these big wins to make up for the losses, since swing trading often is less than 50% successful. If traders do not hold on for the swing, they will not be getting the big wins that they need, and they will lose money. Something opposite to this can happen to scalpers. They might have taken a profitable scalp, but became sad when the trade turned into a huge trend and they watched from the sidelines. When they see another scalp, they take it, but once it reaches their profit target, they decide that the trade could turn into a swing trade, just like last time, and they do not exit. A few minutes later, the market comes back, hits their stop, and they take a loss. This is because most scalps are high-probability trades, and when the edge is large and obvious, the move is usually small and brief, and not the start of a big swing. The best way to make money is to have a sound strategy, and then stick to the plan. For most beginning traders, the plan should be some kind of swing trade, because the winning percentage needed to be a successful scalper is much higher than most traders can maintain for the long term. Once traders take a position, they then have to decide how to manage it. The most important decision that they have to make is whether they are looking for a scalp or for a swing, both of which are discussed in detail in the second book, as is trade management. Only the most experienced traders should consider scalping, because the risk is sometimes greater than the potential reward. This means that they have to win about 70% of the time, which is impossible for anyone except an extremely good trader. You should assume that you will never be that good, because that is the reality. However, you can still be a very profitable trader. If traders are trading the E-minis at a time when the average daily range is about 10 to 15 points, they generally have to risk about 2 points. For example, if they are buying in a bull trend, their protective stop should be about 2 points below their entry price. Alternatively, their stop can be 1 tick below the low of the signal bar, which usually is still about 2 points. Some traders will risk 5 points or more on a swing trade if they feel confident that the trend will eventually resume. This can be a profitable approach for traders who understand the trader's equation. Trade only when the chance of success times the potential reward is significantly greater than the chance of failure times the risk. If a trader is scalping, then he is trying to make between 1 and 3 points on the trade. However, some scalpers think that 2 and 3 point trades are small swings and consider a scalp to be a 1-point trade. Although there are many trades every day where a trader can risk 2 points to make 1 point and have an 80% chance of success, there are many other setups that look similar but have only a 50% chance of success. The problem that most traders have is distinguishing between the two, and even a couple of mistakes a day can mean the difference between making money and losing money. Most traders simply cannot draw the distinction in real time and end up losing money if they scalp. A trader who scalps only the 2 or 3 best setups a day and trades enough volume might be able to make a living as a scalper, but he might also find it difficult to watch the market for hours and be ready to quickly place a trade when one of the rare, brief setups unfolds. The better way for beginning traders to make money is to swing their trades. They can enter all at once or compress their trades by scaling in as the market continues in their direction. This means that they are adding to their positions as their earlier entries have growing profits. They can either exit all at once or scale out as the trade goes their way. For example, if they buy early in a bull trend, their initial stop is 2 points and they are confident that the trade will work, they should assume that the probability of success is at least 60%. Because of that, they should not take any profits until the trade has gone at least 2 points. The mathematics of trading are discussed in the second book. A trader should exit a trade only when the chance of success, here, 60% or higher, times the potential reward is significantly greater than the chance of failure, here, 40% or less times the risk. Since the protective stop is 2 points below the entry price, the risk is 2 points. This means that the trader's equation begins to become favorable only when the reward is 2 points or more. Therefore, if traders take a smaller profit, they will lose money over time, unless they believe that their probability of success is about 80%, which is rarely the case. When it is, an experienced trader can scalp part out at a 1-point profit and still make money while using a 2-point stop. Most traders should never risk more than their reward. So, how should traders swing their trades in that bull trend? This is addressed more in the second book. Swing trading is much more difficult than it appears when a trader looks at a chart at the end of the day. Swing setups tend to be either unclear or clear, but scary. After a trader sees a reasonable setup, he has to take the trade. These setups almost always appear less certain than scalp setups, and the lower probability tends to make traders wait. Trend begins with a breakout, either from a trading range or after a reversal of the current trend. When there is a potential reversal, and it has a strong signal bar, it usually comes when the old trend is moving fast in a strong, final, climactic spike. Beginning traders invariably believe that the old trend is still in effect, and they probably lost on several earlier countertrend trades today and don't want to lose any more money. Their denial causes them to miss the early entry on the trend reversal. Entering as the breakout bar is forming or after it closes is difficult to do because the breakout spike is often large, and traders have to quickly decide to risk much more than they usually do. As a result, they often end up choosing to wait for a pullback. Even if they reduce their position size so that the dollar risk is the same as with any other trade, the thought of risking 2 or 3 times as many ticks frightens them. Entering on a pullback is difficult because every pullback begins with a minor reversal, and they are concerned that the pullback might be the start of a deep correction. Their stop will be hit, and they will lose money. They end up waiting until the day is almost over. When they finally decide that the trend is clear, there is no longer any time left to place a trade. Trends do everything that they can to keep traders out, which is the only way they can keep traders chasing the market all day. When a setup is easy and clear, meaning it has a high probability of success, the move is usually a small, fast scalp. If the move is going to go a long way, it has to be unclear and difficult to take, to keep traders on the sidelines and force them to chase the trend. Since a bull trend has trending highs and lows, then every time the market reaches a new high, traders should raise their protective stop to 1 tick below the most recent low. This is called trailing their stop. Also, if their profit is large enough, they should consider taking partial profits as the market goes above the most recent high. Lots of traders do this, and that is why trends often pull back after reaching a new high. The pullback very often goes below the original entry price, and inexperienced swing traders will have tightened their stops to the break-even price and will get stopped out of a great trend trade. Once the market tests the original entry price and then goes to a new high, most traders would then raise their stops to at least their entry price because they would not want the market to come back to test it a second time after reaching a new high following the first test. Others would put it below the low of the pullback that just tested their original entry. Some traders will allow pullbacks below the signal bar as long as they believe that their premise of a bull trend is still valid. For example, assume that the average range in the E-mini has been about 10 to 15 points lately, and they bought a high 2 pullback in a bull trend on the 5-minute chart. If the signal bar was 2 points tall, they might be willing to hold on to their position even if the market falls below the low of the signal bar, thinking that the pullback might evolve into a high 3, which is a wedge bull flag buy setup. Other traders would exit if the market falls below the signal bar and then buy again if a strong high 3 buy signal sets up. Some might even buy a position that is twice as large as their first because they see the strong second signal as more reliable. Many of these traders would have bought just a half-size position on the high 2 buy signal if they thought that the signal did not look quite right. They were allowing for the possibility of the high 2 failing and then evolving into a wedge bull flag, which might even look stronger. If it turned out to be, they would then feel comfortable trading their usual full size. Other traders trade half size when they see questionable signals, exit if their protective stop is hit, and then take the second signal with a full size if the signal is strong. Traders who scale in as a trade goes against them obviously do not use the signal bar extreme for their initial protective stop, and many look to scale in exactly where other traders are taking losses on their protective stops. Some simply use a wide stop. For example, when the average daily range in the E-mini is less than about 15 points, a pullback in a trend is rarely more than 7 points. Some traders will consider that the trend is still in effect, unless the market falls more than between 50 to 75% of the average daily range. As long as a pullback is within their tolerance, they will hold their position and assume that their premise is correct. If they bought a pullback in a bull trend, and their entry was 3 points below the high of the day, then they might risk 5 points. Since they believe that the trend is still in effect, they believe that they have a 60% or better chance of an equidistant move. This means that they are at least 60% certain that the market will go up at least 5 points before falling 5 points to their protective stop, which creates a profitable trader's equation. If their initial buy signal in the bull pullback came at 5 points below the high, then they might risk just 3 points, and they would look to exit their long on a test of the high. Since the pullback was relatively large, the trend might be a little weak, and this might make them take profits below the trend high. They would try to get at least as much as they had to risk, but they might be willing to get out just below the old high if they were concerned that the market might be transitioning into a trading range, or possibly even reversing into a bear trend. At some point, selling pressure will be strong enough to convert the trend into a trading range, which means that a pullback might fall below the most recent low. Experienced traders have a good sense of when the market is transitioning from a trend into a trading range, and many will exit the remainder of their positions when they believe that it is about to happen. They might then trade the trading range using a trading range approach, which means looking for smaller profits. This is discussed in the second book. They might instead hold on to part of their long positions until either the close or when the market flips into always in short. If it does, they would then either exit their longs or reverse to short. Very few traders can reverse consistently, and most prefer to exit their longs and then reassess the market, and maybe take a break before looking to go short. There are countless ways to trade any day, but when there is a trend like the bull trend in GS shown in figure 18.1, traders should try to swing at least part of their trade. I had extensive discussions years back with a trader who excelled on days like this. He bought early and then determined his initial risk, how far his protective stop was from his entry price. He then took half of his position off once the market reached twice his initial risk and held the other half until there was a clear reversal. If there never was a strong reversal, he exited in the minutes before the close. After every new high, he tightened his stop to below the most recent higher low, since as long as the trend kept making higher highs and lows, it was still strong. If it stopped making higher lows, it was beginning to weaken. There is one sure way to consistently lose money on a day like this, and all traders know it. Successful traders avoid it, but beginners are irresistibly drawn to it. They see the market as constantly overdone. The most recent bar is always at the top of the computer screen, and there surely can't be enough room up there to go higher, and there clearly is a lot of room below. Also, they know trends have pullbacks, so why not short every reversal for a scalp, and then go long on the pullback? Even if the trade is a loser, the loss is not big. They don't buy the pullback when it finally comes, because the market might be reversing into a bear trend, and the buy setup does not look strong enough. Also, since they were short and the market did not quite reach their scalper's profit target, they were rooting for the market to go down just a little bit more, and therefore were not expecting, and actually not wanting, the pullback to end just yet. They saw bars 7, 10, 18, 20, 21, and 24 as reversals that were likely to fall far enough to offer at least a scalper's profit, and as potential highs of the day. However, experienced traders know that 80% of reversal attempts fail and become bull flags, and they held long, took some profits on their earlier longs, or bought more as the pullback progressed. The beginners don't accept this premise, and they take small losses all day, and by the end of the day are shocked that they have lost so much. They have been successful all their lives in other careers and are very smart. I see trading gurus on television who look more like clowns and used car salesmen than like formidable adversaries, so they are confident that they can trade at least as well as those so-called experts. They are right in their assessment of the abilities of those pundits, but wrong in their assumption that those people are successful traders. They are entertainers, and the networks hire them to create an audience that will result in advertising dollars. The networks are companies, and like all companies, their goal is to make money, not to help the viewer in any way. Beginners do not stop losing until they are able to stop themselves from looking for shorts in bull trends or bottoms in bear trends. They can start winning only when they accept that each top is the start of a bull flag. Some of the material that follows will be covered later in books 2 and 3, and is included here because it is important in trend trading. Great swings usually begin with weak setups, like the 2-bar reversal that began at bar 3. Both bars were small dojis, and they followed a large 2-bar reversal top. The setup that leads to the breakout is usually weak enough to trap traders out. Traders wait for a higher probability setup after the breakout occurs, and miss the initial breakout. Entering either on the low probability setup or on the higher probability ones after the breakout are both mathematically sound approaches. Most traders would have decided that the always-in direction was up by either bar 2 or bar 4. That means that they believed that the market was in a bull trend, and they therefore would look for sensible reasons to buy, and there were many. They could have bought as bar 4 broke above bar 2, on the close of bar 4, or at one tick above its high. They could have placed a limit order to buy at or below the low of the next bar and the lows of the next several bars. They would have been filled below bar 5. Some would have placed orders to buy a small pullback to the midpoint of the prior bar, maybe 20 cents down. They also would have looked to buy a bear close because they believed that attempts to reverse should fail. The move from bar 4 to bar 5 was a tight channel, so an attempt to break to the downside was likely to fail. They could have bought below bar 5, on the close of the small bear trend bar that followed, or above it as a failed breakout below a bull micro channel. Bar 7 was a breakout pullback short, but traders expected it to just lead to a pullback. The market broke below the bull micro channel on the move below bar 5, and the rally to bar 7 was a breakout pullback higher high. Traders expected the reversal to fail, and some had limit orders maybe 50 cents down and in the area of the bar 6 low, expecting a double bottom bull flag. Some traders had their protective stops below bar 6 since it was a strong bull trend bar, and a strong bull trend usually would not fall below such a bar. Therefore, buying just above its low was a low-risk, high-reward trade with at least a 50% chance of success. They also could have bought above the bull reversal bar that followed bar 8 since it was a double bottom bull flag setup and a high too long. Bar 6 was the high one. Bar 9 was another break below a bull micro channel, and traders expected it to fail. Some would have had limit orders to buy at the low of the prior bar as the micro channel was growing, and they would have been filled on bar 9. Other traders bought above the bar 9 high as a failed breakout below the bull micro channel. Bar 11 was another high 2 buy setup, but the market had been mostly sideways for over 10 bars, and the bars were getting small. Although this was also a double bottom buy signal, the tight trading range could have continued. So many traders would have waited to see if there was a third pushdown and then looked to buy above the wedge bull flag, which some traders would have seen as a triangle since it would have been sideways instead of down. These traders got long on bar 12 and above bar 12. After the breakout from this bull flag, the market went sideways for several bars and created a breakout pullback by entry above bar 13, and again on the bar 14 outside up strong bull trend bar. This was a high 2 entry bar since bar 13 was a high 1 entry, and the pullback below the next bar was a second leg down in this 4-bar long tight trading range. Some traders bought as the market broke above bar 10, which they saw as a breakout of a trading range in a bull trend. Traders also bought the close of bar 14 and above its high. The next bar had good follow-through, which was a sign of strength, and traders therefore bought its close and above its high. There was a 2-bar pause, creating a small breakout pullback bull flag, and traders bought the breakout above the bar after bar 15. Bar 16 was a doji top, but there was no prior bear strength and no significant selling pressure, and the bar was small and weak compared to the bar 14 bull spike. Traders expected the reversal attempt to fail, and therefore placed limit orders to buy at and below its low. Bar 17 was a failed top buy signal, and bar 19 was a small second push down and therefore a high 2 buy setup. Traders bought as the market went above its high and above the high of the bull bar that followed it, which was a 2-bar reversal buy setup. The move up to bar 20 was another strong bull spike. Traders would have bought at and below the low of the prior bar, on the close of the bull trend bars, and on the close of the first bear trend bar, like the bar after bar 20. Since bar 20 was an especially large bull trend bar in a mature trend, it was enough of a buy climax to warrant a larger correction, one that might go sideways or down to the moving average. There was less urgency for the bulls, who were expecting a high 2 or a triangle. Bar 21 was a 1-bar final flag reversal attempt, but the up momentum was strong. Traders expected another bull flag and not a reversal. Some bought below its low while others waited to see if there would be a high 2, a wedge bull flag, or a triangle. Bar 22 was another double bottom and therefore a high 2 buy setup. Traders placed stop orders to go long above its high and above the high of the inside bar that followed it. Some saw bar 23 as a high 2 buy setup with the bar after bar 20 as the signal for the high 1. Others saw it as a wedge bull flag with the first push down as the bear bar after bar 20. It was also a breakout pullback buy setup for the breakout above the bull flag that occurred on the prior bar. Bar 24 was a very important bar. It was the third push-up and third consecutive buy climax after the spike up from bar 14. The top of the spike was the first push. The channel in a spike and channel bull often ends on a third push-up and is then followed by a correction. Also, bar 24 was a particularly strong bull trend bar in a protracted bull trend. This is just the bar that strong bulls and bears were waiting for. Both saw it as a possible temporary end of the trend, and they expected it to be a brief opportunity to sell before a larger pullback developed. Both expected a correction to have at least 2 legs and 10 bars and to penetrate the moving average. The bulls were selling to take profits, and the bears were selling to initiate shorts. Both sold at the close of bar 24, above its high, at the close of the next bar, and below its low. The bulls thought that the market might be transitioning into a trading range, and that there was a reasonable chance that they could buy again lower. Bar 28 was a 2-legged correction to the moving average, and therefore a high 2 buy setup. It was also the first touch of the moving average all day, and therefore a 20-gap bar buy setup, and was likely to be followed by a test of the bull high. The bears took profits on their shorts here, and the bulls bought for another leg up. The biggest prior pullback of the day since the rally began at bar 3 was 75 cents on the pullback to bar 8. Some traders expected the largest pullback of the day to come after 1100 a.m. or so, and therefore had limit orders to go long at 75 cents below the most recent swing high. They might have scaled in at 75 cents below that, and maybe risked up to a little more than twice the size of that first pullback, or about $1.60. Throughout the day, traders would have expected pullbacks to remain less than the first, and they would have had limit orders to buy any pullback that was about half as big, or maybe 40 to 50 cents. Pullback to bar 11 was 40 cents, which meant that traders tried to buy a 50-cent pullback, and when they did not get filled on the second attempt on the bar before bar 12, they decided to chase the market up and bought above the high of bar 12. Some traders saw the bars 9 and 11 double bottom and would have placed limit orders to buy just above its low, maybe 30 cents down from the high. Traders would then have to determine where a worst-case protective stop would be. They should pick a level where they would no longer want to be long. An obvious location would have been below the bar 8 low, since a bull trend has a series of higher highs and lows, and after each new high, the bulls expect the next pullback to stay above the most recent higher low. Since they were planning to get long at $161.05, 30 cents down from the high, and they would need to risk to around $160.35 or 70 cents lower. They had to determine the position size. If they normally risk $500 or less on a trade, they could have bought 600 shares of GS. Since they were risking 70 cents, and they always should have a reward that is at least as large as their risk, their profit target should have been at least 70 cents above their entry. This was clearly a strong trend day at this point, and the probability of success was therefore at least 60%, and maybe higher. On a strong trend day like this, it was far better to use a generous profit target. Traders should not have tried to take any profit until the market went to at least twice their risk, or $1.40 above their entry price. They would have placed a limit order to sell half of their position at $162.45. After the bar 12 strong bull trend bar broke above the triangle, some thought of it as a wedge bull flag. They could have tightened their protective stop to just below its low at $161.05, reducing their risk to less than 20 cents. After the bar 14 strong bull trend bar breakout, they could have tightened their stop to just below its low, reducing their risk to a penny. Their limit order to take profits on 300 shares would have been filled on bar 20, giving them $420. At that point, they could have tightened their protective stop to below the bar 19 start of that most recent bull spike. If the stop was hit, they would have made about 80 cents on their remaining 300 shares. At this point, they would have held their position until there was a clear reversal down or until the close. When you have a large profit, it is usually wise to exit in the final hour or so on any setup that could lead to a larger pullback, and then maybe look to get long again once that two-legged pullback is complete. The bear reversal bar at bar 24 was a third push-up and was followed by climax bar, so the market could finally have been getting ready to pull back to the moving average. If traders exited below its low, they would have made $2.00 or $600 on their remaining 300 shares. If they held until the close, they would have made $375 on those shares. The market never even clearly became always in short. Many traders would have bought on a limit order at one tick above the moving average as bar 27 tested the moving average, since it was a 20-gap bar by setup, and held for a test of the high. Some traders would have bought on the close of bar 27 because it was the first bear trend bar with a close below the moving average. Although it was the second bar of a two-bar bear spike and a breakout below bar 25, the bears needed follow-through before believing that the market had flipped to always in short, and instead got a bull inside bar for the next bar. This was the bottom of a developing trading range and the test of the beginning of the channel up from the bar 22 pullback, from the 4-bar bull spike up to bar 20. The bull bar that followed bar 27 also closed above the moving average. Some bulls would have bought on the close of that bull bar, while others would have bought at one tick above its high. Their entry would have been 3 bars later. Traders would also have bought above the high of the inside bar that followed bar 28, since it was a high 2-buy signal, ending 2 legs down from the high of the day. It was also a small wedge bull flag where bar 25 was the first push down and bar 27 was the second. Pullback is a minor trend in the opposite direction, and traders expect it to end soon and for the major trend to resume. When GS began its second leg down from the bar 24 high, it formed a lower high at bar 26, and the bears needed it to form a series of lower highs and lows to be able to convince the market that the trend had reversed to down. Some therefore shorted as the market broke out below the bar 25 swing low, hoping for a series of large bear trend bars. Instead, bar 25 was a small bear trend bar and there was no follow-through. In fact, the rally up showed that most traders instead bought the breakout below bar 25 because they believed that the sell-off was only a pullback and doomed to be a failed attempt at reversing the major trend into a bear trend. Since most reversal attempts fail, the first pullback in a strong bull trend that has a second leg down usually is bought aggressively as it breaks below the prior swing low, and many bulls bought this one, even though it took several bars before they could turn the market up again. This was a sign that they were not as aggressive as they could have been. This told traders that the pullback might evolve into a larger trading range, which it ultimately did. Many traders use trend lines for entering and exiting. Some would have taken partial profits near the high of bar 7 as it moved above the trend channel line. They also would have bought as bar 9 fell below the bull trend line and above the bar 9 high, since they saw bar 9 as a failed channel breakout. Bar 12 broke above a small bear trend line, and traders bought as the bar moved above the line since they saw that as the end of the pullback and the resumption of the bull trend. Bar 24 was the third push-up in the channel that followed the two-bar bull spike that began at bar 14, and some traders would take profits on their longs above that line, even on the strong bull close of bar 24. The bar was an especially large bull trend bar and the third consecutive bull climax since bar 14, and the market was likely to have a more complex correction. What better place to take profits than on a buy vacuum test of a trend channel line on the third consecutive buy climax? The move down to bar 28 broke below the bull trend line and held below it for many bars, so traders wondered if a larger correction might be starting. This made many quicker to take profits. When the move up from bar 28 could not produce any strong bull trend bars, traders thought that the market might be in a trading range and therefore took profits on the bar 29 test of the bar 26 lower high. This was a potential double top bear flag and lower high trend reversal. The next bar was a bear trend bar, which indicated that the bulls were becoming less aggressive and the bears were becoming stronger. When a bull trend is very strong, traders can buy for any reason if they use a wide enough stop, and many traders like to buy on breakouts above prior swing highs. However, buying pullbacks before the breakout generally offers more reward, smaller risk, and a higher probability of success. Breakout traders will place buy stops at one tick above the old high and will be swept into their longs as the market breaks above the old high. The most common reason for traders failing to buy a pullback is that they were hoping for a larger or better-looking pullback. Many pullbacks have bear signal bars or follow 2 or 3 bar bear spikes, making traders believe that the bull trend needs to correct more before resuming. However, it is important to get long when there is a strong bull trend, and a trader should place a buy stop above the prior swing high when the trend is very strong, in case the pullback is brief and the trend quickly resumes. Reasonable entries included the bar 4 breakout above the bar 2 high and the breakouts up to bar 10 as it moved above bar 7, the bar 14 spike as it went above bar 10, and the bar 20 spike as it moved above bar 16. These old highs are often the highs of higher time frame bars, like on the 15 or 60-minute charts, so the entry is usually a breakout above the high of a prior bull trend bar on these higher time frame charts. Since higher time frame charts have larger bars and the protective stop is initially below the signal bar, the risk is greater and traders should trade smaller size, unless they are only looking for a quick small scalp. After the trend has gone on for a while, the pullbacks become deeper and last for more bars. Once the two-sided trading becomes apparent, the strong bulls begin to take profits above swing highs rather than buying new positions, and the strong bears begin to scale into shorts as the market goes above the old highs. For example, the bear bar after bar 20 and the bar 22 bear bar were signs of selling pressure, so most traders would have used the move above the bar 21 high to take profits rather than to buy more. At some point, most traders will see new highs as shorting opportunities and not simply as areas to take profits. Although many traders shorted below the bear bar after bar 24, most traders still believed that the trend was up and that there would be a test of the bull high after a pullback. Until there has been a strong bear move that breaks well below the bull trend line, the strong bears usually will not dominate the market. Since this was a trend day, a trader would ideally swing part, take profits along the way, and then go back to a full position size on every pullback. However, most traders cannot continue to hold part of their trade for a swing and also repeatedly scalp the other part. Traders instead should try to put on a full position early and not take additional signals, and instead scale out of their profits as the market works higher. There are many ways to do this. For example, if they bought early on and had to risk about $1.00, probably less, they might have taken a quarter off after a $1.00 profit and another quarter off at $2.00, and maybe a third quarter at $3.00, and held onto the final quarter until either a strong sell signal formed or until the end of the day. It was better if they instead waited until the market rallied $2.00, or twice their initial risk, before taking their initial profit, because they had to ensure that they were adequately compensated for taking that initial $1.00 risk. It does not matter how they did it, but it was important to have taken some profit along the way in case the market reversed down. However, since traders subjected themselves to risk, they must resist the temptation to exit with too small a reward. As long as the trend is good, it is always best to try to resist taking profits until the market has gone at least twice as far as your initial risk. If traders are out of half of their position, but then see another strong buy signal, they might put part or all of the other half back on, at least for a scalp. But most traders should simply stick to their original plan and enjoy their growing profit. With all of these buy signals, traders could have accumulated an uncomfortably large long position if they kept adding new longs, which they should not have done. Instead, they should have simply held their position until a possible end of the trend, like at bar 24, or they could have scalped out part after each new high as soon as a bar had a weak close, like at bars 16, 21, or 24. Then they could have put the scalp portion back on when they saw another buy signal. They would have continued to hold their swing portion until the end of the trend. When did traders see this day as a trend day? Aggressive bulls thought that the gap-up and strong bull trend bar had a reasonable chance of leading to a trend from the open bull trend day, and they might have bought on the close of bar 1 or 1 tick above its high. Their initial protective stops were 1 tick below the bar 1 low, and they planned on holding part or all of the position until the close, or until a clear short signal formed. Other traders always look for double bottoms on gap-up days, and they would have bought above the 2-bar reversal that began at bar 3, which formed an approximate double bottom with bar 1, or with the low of doji bar that followed it. Bar 4 was a strong bull trend bar that broke above the opening range and closed above the bar 2 high. Some traders bought at 1 tick above the bar 2 high, and others bought on the close of bar 4 or 1 tick above its high. This breakout bar was a statement by the bulls that they owned the market, and most traders at this point believed that the market was always in long. For the time being, the best place for a protective stop was 1 tick below its low, but since that was almost $1 lower, traders had to choose a small enough position size so that they were trading within their comfort zone. Most traders saw the day as a bull trend day by bars 5 or 7, and probably as soon as bar 4 closed. Once traders believe the day is a trend day, if they are flat, they should buy a small position either at the market or on any small pullback. Traders could have placed limit orders to buy below the low of the prior bar and to buy at a certain number of cents down, like maybe 20, 30, or 50 cents. Others would have looked to buy above a high 2 on a stop or on a moving average pullback. Buying above the bar 8 2-bar reversal was a reasonable long, as was the wedge bull flag. Some saw it as a triangle that ended in a 2-bar reversal at bar 12. The protective stop would still have been below the bar for low or maybe below its midpoint. Traders need to trade small enough so that their risk is within their normal risk tolerance. Other traders had their stops below the bars 6 and 8 double bottom, and if they got stopped out but the market then formed another buy signal and they believed that the bull trend was still intact, they would have bought again. The most important thing that traders must force themselves to do, and it is usually difficult, is as soon as they believe that the day is in a trend, they must take at least a small position. They must decide where a worst-case protective stop would be, which is usually relatively far away, and use that as their stop. Because the stop will be large, their initial position should be small if they are entering late. Once the market moves in their direction and they can tighten their stop, they can look to add to their position, but they should never exceed their normal risk level. When everyone wants a pullback, it usually will not come for a long time. This is because everyone believes that the market will soon be higher, but they do not necessarily believe that it will be lower anytime soon. Smart traders know this and therefore they start buying in pieces. Since they have to risk to the bottom of the spike, they buy small. If their risk is 3 times normal, they will buy only 1/3 of their usual size to keep their total dollar risk within their normal range. When the strong bulls keep buying in small pieces, this is buying pressure, and it works against the formation of a pullback. The strong bears see the trend, and they too believe that the market will soon be higher. Since they think it will be higher soon, they will stop looking to short. It does not make sense for them to short if they think that they can short at a better price after a few more bars. So the strong bears are not shorting and the strong bulls are buying in small pieces, in case there is no pullback for a long time. What is the result? The market keeps working higher. Since you need to be doing what the smart traders are doing, you need to buy at least a small amount at the market or on a 1 or 2 tick pullback or a 10 or 20 cent pullback, and risk to the bottom of the spike, the low of bar 4 for most traders, but some would have put their stops below the low of bar 3. Even if the pullback begins on the next tick, the odds are that it won't fall far before smart bulls see it as value and buy aggressively. Remember, everyone is waiting to buy a pullback, so when it finally comes, it will only be small and not last long. All of those traders who have been waiting to buy will see this as the opportunity that they wanted. The result is that your position will once again be profitable very soon. Once the market goes high enough, you can look to take partial profits or you can look to buy more on a pullback, which will probably be at a price above your original entry. The important point is that as soon as you decide that buying a pullback is a great idea, you should do exactly what the strong bulls are doing, and buy at least a small position at the market. After the market moved above the bar 7 high, many traders trailed their protective stops below the most recent swing low, which was at bar 8. As long as the market holds above the most recent swing low, the trend is likely still very strong. If it starts to make lower lows, the market could be transitioning into a trading range or even a bear trend. In either case, traders would then trade it differently from how they would trade a one-sided market, a trend. Bulls would continue to buy pullbacks all day long, and after the market went to another new swing high, they would move their protective stop to below the most recent swing low. For example, once the market moved above the bar 16 high, traders tightened their protective stops to below the bar 19 low. Many traders moved their stops to break-even once there was a pullback that tested their entry price, and then the market reached a new high. They did not want the market to come back down to their entry price a second time, and if it did, they would have believed that the trend was not strong. Bar 24 was the third push-up from the spike up to bar 15. Bar 21 was the second push-up, so the market was likely to correct for a couple of legs sideways to down. The bar after it was a bear inside bar, so the market might have reversed down at this point, especially since this would have been a failed breakout above the trend channel line. The market made a couple of attempts to pull back to the moving average earlier in the day, so it was reasonable to assume that it might succeed this time. This was a good place to take profits on the swing longs. Aggressive traders might have gone short for a scalp, but most traders would have waited to see if a 20-gap bar buy signal formed at the moving average. Should traders try to take most of these entries? Absolutely not. However, if they are watching on the sidelines, wondering how to get in, all of these setups are reasonable. If they take just 1 to 3 of these swing entries, they are doing all that they need to do and should not worry about all of the others. Chapter 19. Signs of strength in a trend. There are many characteristics of strong trends. The most obvious one is that they run from one corner of your chart to the diagonally opposite corner with only small pullbacks. However, in the early stages of a trend, there are signs that indicate that the move is strong and likely to last. The more of these signs that are present, the more you should focus on with trend entries. You should start to look at counter-trend setups only as great with trend setups, with you entering on a stop exactly where those counter-trend traders will be forced to exit with a loss. One interesting phenomenon in trend days is that on many of the days, the best reversal bars and the biggest trend bars tend to be counter-trend, trapping traders into the wrong direction. Also, the lack of great with trend signal bars makes traders question their entries, forcing them to chase the market and enter late. Finally, once you realize that the market is in a strong trend, you don't need a setup to enter. You can enter anytime all day long at the market if you wish with a relatively small stop. The only purpose of a setup is to minimize the risk. Here are some characteristics that are commonly found in strong trends. There is a big gap opening on the day. There are trending highs and lows swings. Most of the bars are trend bars in the direction of the trend. There is very little overlap of the bodies of consecutive bars. For example, in a bull spike, many bars have lows that are at or just 1 tick below the closes of the prior bar. Some bars have lows that are at and not below the close of the prior bar, so traders trying to buy on a limit order at the close of the prior bar do not get their orders filled, and they have to buy higher. There are bars with no tails or small tails in either direction, indicating urgency. For example, in a bull trend, if a bull trend bar opens on its low tick and trends up, traders were eager to buy it as soon as the prior bar closed. If it closes on or near its high tick, traders continued their strong buying in anticipation of new buyers entering right after the bar closes. They were willing to by going into the close because they were afraid that if they waited for the bar to close, they might have to buy a tick or two higher. Occasionally, there are gaps between the bodies. For example, the open of a bar might be above the close of the prior bar in a bull trend. A breakout gap appears in the form of a strong trend bar at the start of the trend. A trend bar is a type of gap, as discussed in Book 2. Measuring gaps occur where the breakout test does not overlap the breakout point. For example, the pullback from a bull breakout does not drop below the high of the bar where the breakout occurred. Micro-measuring gaps appear where there is a strong trend bar and a gap between the bar before it and the bar after it. For example, if the low of the bar after a strong bull trend bar in a bull trend is at or above the high of the bar before the trend bar, this is a gap in a breakout test and a sign of strength. No big climaxes appear. Not many large bars appear, not even large trend bars. Often, the largest trend bars are countertrend, trapping traders into looking for countertrend trades and missing with trend trades. The countertrend setups almost always look better than they with trend setups. No significant trend channel line overshoots occur, and the minor ones result in only sideways corrections. The corrections after trend line breaks go sideways instead of countertrend. Failed wedges and other failed reversals occur. There is a sequence of 20 moving average gap bars, 20 or more consecutive bars that do not touch the moving average, discussed in Book 2. Few, if any, profitable countertrend trades are found. There are small, infrequent, and mostly sideways pullbacks. For example, if the E-min's average range is 12 points, the pullbacks will all likely be less than 3 or 4 points, and the market will often go for 5 or more bars without a pullback. There is a sense of urgency. You find yourself waiting through countless bars for a good with trend pullback and one never comes, yet the market slowly continues to trend. The pullbacks have strong setups. For example, the high 1 and high 2 pullbacks in a bull trend have strong bull reversal bars for signal bars. In the strongest trends, the pullbacks usually have weak signal bars, making many traders not take them and forcing traders to chase the market. For example, in a bear trend, the signal bars for a low too short are often small bull bars in 2 or 3 bar bull spikes, and some of the entry bars are outside down bars. It has trending anything, closes, highs, lows, or bodies. Repeated two-legged pullbacks are setting up with trend entries. No 2 consecutive trend bar closes occur on the opposite side of the moving average. The trend goes very far and breaks several resistance levels, like the moving average, prior swing highs and trend lines, and each by many ticks. Reversal attempts in the form of spikes against the trend have no follow-through, fail, and become flags in the direction of the trend. When a trend is in runaway mode, there will likely be no pullbacks for many bars, and the bars will be good-sized trend bars with mostly small tails. Since you want to keep scalping more as the trend continues while still holding on to the swing portion of your position, you might consider looking at the 3-minute chart for additional with trend setups. It often has more pause bars, countertrend inside bars, and 1-bar pullbacks that allow for with trend entries. The 1-minute chart also has with trend entries, but in addition, it has some countertrend setups, which can be confusing when you are trying to trade only with trend. This, along with the speed of the reading required, can create too much stress during a runaway trend and can interfere with your ability to trade effectively. Since you need to be making sure that you catch every with trend entry, it is best to trade only off the 5-minute chart in a runaway trend. Once you become experienced and successful, you might consider also looking at the 3-minute chart. Over time, the trend weakens. More signs of two-sided trading develop, and the signs of strength begin to disappear. For example, in a bull trend, traders begin to take profits above the highs of the prior bars and above swing highs, and aggressive bears begin to short above the highs of bars and above swing highs and will scale in higher. The strong bulls will eventually only buy pullbacks. The initial bull spike is replaced by a bull channel, and it eventually evolves into a trading range. Large gaps that don't reverse early usually mark the start of a strong trend for the day, and the day often closes at or near the high or low in a bear. As shown in Figure 19.1, the 5-minute E-mini gapped up 11 points, which is huge, and the first bar was a bull trend bar. Also, the market did not test the moving average for over 2 hours, another sign of strength. Notice how there was not much emotional behavior, big bars, climaxes, big swings. Quiet markets with lots of small bars, many of which are dojis, often lead to the biggest trends. On days like this, the institutions have a huge amount to buy and they want lower prices. But when the lower prices don't come, they have to fill their orders in pieces all day long, at increasingly higher prices. Even though they see the trend day unfolding and expect that they will likely have to be buying at higher prices throughout the day, they don't dump all of their buy orders onto the market at once, because this could cause a climactic spike up and then possibly a reversal down below their average entry price. They are content filling their orders in manageable pieces all day long, understanding that they are buying higher and higher, but knowing that the market will likely go higher still. Also, strong days like this usually have higher prices over the next 1 to several days. Deeper discussion of this chart. The market broke out above yesterday's high in Figure 19.1, but the breakout became a failed breakout when the market turned down below the bear inside bar that followed the bar 2 strong bull spike. Big gap-up days often test the low of the open and form a small double-bottom bull flag. When the opening range is small like this, that market is in breakout mode and traders will enter in the direction of the breakout. On a big gap-up day, the odds favor an upside breakout. Aggressive bulls could enter above bar 3, based on the double bottom, but many bulls entered on a stop above the bar 2 high of the opening range. The day was a trend from the open bull trend day and a trend resumption bull day. The market had a small 2-legged move down to bar 3. Bear trend bar and 2 dojis composed the first leg. The second leg was made up of a bear trend bar with a large bear tail on top. The tail was the pullback that ended the first leg down, followed by a doji. This variant of a 2-legged move would certainly have 2 clear legs down on a smaller time frame chart, setting up an ABC buy signal. A trader could buy at 1 tick above bar 3. It was also a test of the gap, forming a double bottom with the low of bar 1. Since this was a possible trend day and as such could extend much further than most traders would ever suspect, smart traders would swing part or all of their positions. Note how the open of the day was very close to the low of the day, which is a sign of strength, and trend from the open days that open within a few ticks of the low of the day, often close within a few ticks of the high of the day, and there is often a trend into the close. Bar 5 was a high 1 breakout pullback after a strong move up, 4 bull trend bars, and a high 1 is always a good buy in the spike phase of a strong bull trend. The bar 4 low 1 break below the trend line and reversal from the new high was not a short, even for a scalp. In fact, it is incorrect to use the term low 1 here because a low 1 sets up trades in trading ranges and bear trends, not strong bull trends. After such a strong up move, smart traders would only be looking to buy and would consider a short only if there was a second entry. Bar 6 was a low 2, which was a second entry short and a possible top of a trading range within a bull trend. However, in the face of the strong bull trend, shorts would only scalp this trade. They would swing it only if there was first a prior strong down move that broke a substantial trend line, maybe 20 or more bars. If they shorted, they would be quick to exit and then they would look for a long setup for a swing trade. With trend entries in a strong trend should be mostly swung, with only a small portion taken off as a scalp. If you find that you missed a with trend entry, stop looking for counter-trend scalps and start trading only with trend setups. During a trend day, you must try to catch every with trend signal, because that is the source of the most consistent money. Since the bar 6 entry bar was a strong bear trend bar, it is a breakout and therefore a spike. Spikes are usually followed by channels with at least 2 more pushes, but when they occur against a strong trend, they often just have 1 more push and become a 2-legged bull flag. In any case, after a spike down, there was a good chance for at least 1 more leg down. Bar 7 was an entry bar for a low too short into the second leg down, but after a 6-bar tight trading range, any breakout in either direction would likely fail after not going very far. Bar 8 was a two-legged pullback and the first to the moving average in a strong bull trend, which is a great buy. Whenever the market stays away from the moving average for 20 bars or more, a 20-gap bar buy setup, the trend is very strong and the odds are high that there will be buyers at the moving average. Bar 9 was a reversal at a new swing high, but there were no bear trend bars among the prior 7 bars, so no short could be taken unless a second entry forms. Bar 10 was a second entry, but in a tight trading range in a bull trend, any short is a scalp at best, and it is probably best to pass on this trade. Sideways price action in a bull trend is usually a bull flag and will usually break out in the direction of the trend that was in effect before it formed. Outside bars are less reliable, but you could consider taking the short for a scalp since second entries are so reliable. 3 small dojis developed at the moving average. This was a small, tight trading range and therefore had a magnetic effect. The odds were high that there would be a trend bar breakout in either direction and it would fail. Traders held short and risked maybe for ticks. The bar 11 bull trend bar breakout failed, as expected, allowing traders to take a 4-tick scalp profit on the next bar. Bar 13 was a breakout test that extended 1 tick below the high of the signal bar that generated the strong move up from the bar 8 long. The move down from bars 9 to 13 was very weak and appeared essentially sideways. The market struggled to get down to test the breakout, meaning the bears lacked conviction. Bar 13 also set up a high 4 entry just below the moving average, and it followed the first moving average gap bar of the day, a bar with a high below the exponential moving average. This was a moving average gap bar setup in a strong trend, and should be expected to test the high of the bull trend with either a lower high or a higher high. A moving average gap bar in a strong trend often leads to the final leg of the trend before a deeper, longer-lasting pullback develops, and the pullback can grow and become a trend reversal. This might have happened on the following day. Bar 13 formed a higher low higher than bar 8 following a higher high at bar 9 and is part of trending bull swings. It is essentially a double bottom bull flag with bar 8. Bar 14 was a high 2 breakout signal bar, and the high 1 was the prior bar. Bar 15 was a signal bar for a final flag short, but the market never triggered the entry because it did not trade below the signal bar low. However, as a bear bar, it was a small leg down. The next bar was a bull trend bar, and then there was another bear trend bar. This second bear trend bar was a small second leg down and therefore was a high 2 buy setup. Bar 17 was the first breakout of a bull micro channel on a strong bull day, and therefore it was a setup for a buy at 1 tick above its high. The channel had a wedge shape, and although traders would not short here, the theoretical protective buy stop for shorts is 1 tick above the high of the wedge. There was a large bull trend bar that ran through those buy stops, showing a strong rejection of the bear case. The bar was so strong because there were bulls who expected the bar 17 short to fail and therefore placed buy stops above its high to get long, and there were the bears who got stopped out at 1 tick above the bar 16 top of the wedge. Bar 18 broke above a bull trend channel line and gave a low 2 short signal. However, on a strong trend day, smart traders will short only if there is first a strong bear leg that broke a trend line. Otherwise, they would view all short setups as buy setups and place orders to go long exactly where the weak shorts would have to cover, like 1 tick above the highs of bars 17 and 19. Bar 19 was a 1-bar trend line break that failed, and therefore a buy setup. There was a 2-bar bull reversal that became the signal for the long. As shown in figure 19.2, one peculiarity of trend days is that often the best-looking reversal bars and trend bars are countertrend, trapping traders into losing trades in the wrong direction, bars 1 through 8. Notice how there was not a single great bear reversal signal bar all day, yet this was a huge bear trend. Just look at the moving average. The market could not put 2 consecutive closes above it until the gap bar at the top of the rally that began with bar 8. This was a bear trend, and every buy should be viewed as a short entry setup. Just place your entry order exactly where the longs would have their protective stops and let them drive the market down as they liquidate. The weak sell signals are a key reason why the trend is so relentless. Bears keep waiting for a strong signal bar so that they can short their full position. Trapped bulls keep waiting for strong evidence that the trend is strong and that they need to exit immediately. The signs never come, and both the bulls and the bears keep waiting. They look at the trend and see lots of bull bars and 2 or 3 bar bull spikes, so assume and hope that this buying pressure will soon create a larger rally. Even if they see that the market cannot get above the moving average and that all of the pullbacks are very small, they deny these signs of a strong trend and keep hoping for the bulls to lift the market to a level where they feel more comfortable shorting. It never happens, and both the bears and the trapped longs continue to sell in pieces all day long, just in case the rally that they want never comes. Their relentless selling, along with the aggressive, relentless shorting by the strong bears who see this as the very strongest of bear trends, makes the market work lower and lower all day without any big pullback. When traders cannot get filled on a limit order to buy at the close of the prior bar, the trend is strong. In figure 19.3, as soon as bar 1 closed on its high, some traders would immediately place a limit order to buy at the price where that bar closed, hoping to get filled during the opening seconds of the next bar, bar 2. But since the low of bar 2 never dipped below the close of bar 1, the limit order would likely not get filled. Instead, the buyer would keep trying to buy higher. Bars 3, 4, and 5 were also very strong. Although as soon as bar 3 closed, a trader who placed a limit order to buy at the level of that close would have been filled during the first few seconds of bar 4 because the low of bar 4 dipped 1 tick below the close of bar 3. Usually when there is a series of strong bars like that, they create a spike, and the market typically then develops a bull channel. However, that is not always the case. The next day, bars 6 through 9 were also strong, but they led to a lower high. Yesterday was a spike and channel bull trend day, so the start of the channel should get tested today. That was a downside magnet in the market, and when the market opened below yesterday's bull trend line, the lower high following the bars 6 to 9 spike led to a trend reversal down. Stock traders would describe this bull channel up to yesterday's high as a crowded trade. Everyone who wanted to buy had already bought, and there was no one left to buy. As the market started to fall, all of the buyers in the channel were quickly holding losing positions, and then everyone rushed to the exits to minimize their losses and protect some of their profits. The result was that the market fell quickly. Deeper discussion of this chart. The open broke out below the bull channel of yesterday's spike and channel in figure 19.3, and bar 6 was a bull trend bar that set up a failed breakout long. The failed breakout became a lower high and breakout pullback short with a second entry below the bull bar that followed the 705 AM. PSD bear spike. Chapter 20. 2 legs. The market regularly tries to do something twice, and this is why all moves tend to subdivide into 2 smaller moves. This is true of both with trend and counter-trend moves. If it fails in its 2 attempts, it will usually try to do the opposite. If it succeeds, it will often then extend the trend. Everyone is familiar with an ABC pullback and a trend that unfolds in 3 steps. There is a counter-trend move, a small with trend move that usually does not go beyond the trend's extreme, and then a second counter-trend move that usually extends deeper than the first. Trends themselves also tend to subdivide into 2 smaller legs as well. Elliott wave followers look at a trend move and see 3 with trend waves. However, it is better to look at the first strong with trend leg as the start of the momentum, the Elliott wave 3, even if there was a prior with trend move or wave, Elliott wave 1. That strong with trend move often subdivides into 2 smaller with trend moves, and after a pullback, the trend will often make 2 more pushes to test the extreme of the trend. These 2 pushes create Elliott wave 5. This 2-legged view of markets makes more sense to a trader since it offers sound logic and abundant trading opportunities, unlike Elliott wave theory, which is essentially useless to the vast majority of traders who are trying to make money. A break of a trend line is the start of a new leg in the opposite direction. Any time there is a new trend or any capitulation of one side, there will usually be at least a 2-legged move. This can occur in a pullback in a trend, a breakout, a major reversal, or any time that enough traders believe that the move has sufficient strength to warrant a second attempt to test whether or not a protracted trend will develop. Both the bulls and the bears will be in agreement that the momentum is strong enough that a test will be needed before they develop a strong conviction one way or the other. For example, in a two-legged rally in a bear trend, bulls will take profits above the first leg, new bears will short, and other bears who shorted the first up leg will add to their shorts as soon as the second leg up goes above the high of the first leg. If all of these shorts overwhelm the traders who bought the breakout above the first leg up, the market will go down and enter either a trading range or a new bear phase. Some complex two-legged moves take place over dozens of bars, and if viewed on a higher time frame chart, would appear clear and simple. However, anytime traders divert their attention away from their trading charts, they increase the chances that they will miss important trades. To be checking the higher time frame charts for the one signal a day that they might provide simply is not a sound financial decision. Two legs is the ideal, but there is some overlap with three push patterns. When there is a clear double top or double bottom, the second push is the test of the prior price where the market reversed earlier, and if it fails again at that price, a reversal or pullback is likely. But when the first move is not clearly the possible end of a trend, the market will often then make a two-legged test of that extreme. Sometimes both legs are beyond the prior extreme, creating a clear three-push pattern. At other times, only the second leg exceeds the prior extreme, creating a possible two-legged higher high at the end of a bull trend, or a two-legged lower low at the end of a bear trend. Sometimes one or both of the legs of a two-push move are composed of two smaller legs, so that the overall move actually has three legs. This is the case in many three-push patterns where often two of the pushes really are just part of a single leg. However, if you look carefully at the leg that has the two small legs and think about what is going on, that leg with its two small legs is comparable in strength or duration or overall shape to the other leg that has just a single move. This is difficult and frustrating for traders who want perfect patterns. But when you trade, you are always in a gray fog and nothing is perfectly clear. However, whenever you are not confident about your read, do not take the trade. There will always be another trade before too long that will be much clearer to you. One of your most important goals is to avoid any confusing setups, because losses are hard to overcome. You do not want to spend the rest of the day struggling to get back to break-even, so be patient and take only trades where you are comfortable with your read. Every trend line break and every pullback is a leg, and each larger leg is made of smaller legs, see figure 20.1. The term leg is very general and simply means that the direction of movement has changed, using any criterion that you choose to determine that the change exists.